All right. I know a lot of you guys are still joining into the webinar. So as we know, we're going to start in about 10, 15 minutes. So those of you guys who are just joining in, please hang in there. And I know some of you guys are, and if you are, watching this live on YouTube, then please do know that we do not record these. So, we're going to go ahead and delete it right afterwards. So if you want to ask your questions, then you can certainly join us in the webinar. I'm going to put a link here in the YouTube live, so you can join it. You can join us on Zoom, so that way you can ask all of your live questions. So the format will be the same. We're going to go through the presentation. We'll talk about some of the things that Trump is planning on doing. So we're certainly going to touch on that, but obviously none of that has been finalized yet. So a lot of that can certainly change. So we're not going to spend too much time on that. What we will do today is we're going to spend a lot of time talking about our 2024 tax filing. What are some of the common things that we see people miss? Why are people so disorganized? What can they do to prepare themselves for filing their 2024 tax returns? What are some of the most common deductions and credits that we see people miss? What are some of the reasons why people get audited? And this year going to be a little bit unique year compared to previous years because I think, as you can imagine, lately there has been a lot of talks about government are letting people go. So that means there's going to be a lot of short staffing. And whenever there's a short staffing, that means everything becomes a nightmare for taxpayers, right? If you want to, talk to IRS, or you want to deal with the audit, or if something get caught up in a system. So all of those kind of problems will happen this year, just mainly because of short staffing, really. So we need to be extra cautious. We want to make sure we don't make mistakes on our tax returns. We want to make sure that we report all our income. Then there are a lot of documents related to compliance. We want to make sure all of those are well taken care of. We want to tidy up our paperwork this year more than ever before, because we don't want to get stuck in that issue if we get selected for an audit or something like that, and then we have to deal with all that mess. So that's the plan for today's webinar. So please hang in there. Give me another 10 minutes or so, and then we'll get started. If you have friends, family members, you would like them to join the webinar, they certainly can. Just share the Zoom link with them, or have them go to YouTube Live, and they can grab the link from there as well. So I'm going to pause just for a second, and I'll come back just in a minute here. So I have posted a link in the comment section as well. And let me see if can I make it highlight somehow, so that way people have an easy access to it. But anyhow, if you go in the comment, you should be able to see that link to join the Zoom call, because you certainly can ask any questions on YouTube Live. So if you want to ask questions, just go to Zoom link, and then you can ask your questions from there. It's open to anyone, whether you're our client or you're not our client, or whether you live in the United States or you live in a different country. If you do any business anywhere, and you need to file your taxes in the United States, I think you're going to be very, very helpful for you guys. And towards the end of the webinar, maybe in about hour and a half, we're going to open it up for Q&A session, and we'll open it up and we'll take all of your questions live, and we'll try to answer those for you. Oh, look at that. Somebody's helping me out here, giving me a little hint there about Trump tax updates. So we'll get to see those pretty soon as well. So 10 a.m. PST, that's when we'll get started. I've already sent out an email. Oh, I should also put this, um, I should also put that on my group here. So just in case somebody wants to join, let me do that. I think that's important. Okay, some of you guys want to get the YouTube link. I I can do that here. I hope that's a right link. I think you can do that and join it through YouTube. Yeah, and please share it with friends, family members, if you want. I will also put the YouTube link in case you want to watch it on YouTube. So obviously no questions on YouTube. Well, I guess you can always put questions in a comment and I'll try to ask those on your behalf. So no problem there as well. So all the early risers, welcome. I see Arvind Bhai, Ashok ji, Gopal ji, Harsh ji, Jay, Meena, Meera, Ranjit, Sanjay, Sham, Wahid. Surprised no Sanjeev in the attendee list just yet. So those of you guys watching on YouTube Live, please understand that we're going to get started here in a few minutes, as we are doing most of the conversation on Zoom, but this is the first time I'm trying to put this on YouTube as well. So hopefully those of you guys who are not joining through Zoom, you have access to it as well. Because I think this is important, no matter where you are in the country, understanding how to prepare for your tax return. So many times when people come to us for tax filing, they don't have all their documents together, or then we have to kind of go back and explain to them what are some of the critical things that they're missing and why. And it takes a lot of time. So I think those of you guys who attend today's webinar, it's going to help you a lot. By the way, Sanjeev ji, are you able to hear me? Just want to make sure that you can hear me and everything is good on your end as well.
Yes, I can hear you, Deepak. All
All
clear.
All right.
All
So,
clear.
Sanjeev ji, this time, first time, what we are doing is we obviously have all bunch of people on Zoom. That's what you see. But on the other screen, because I think this particular webinar is going to be helpful for a lot of people. So it's also going live on YouTube. So people will be able to watch it there as well. But obviously, as per your request, we will delete it afterwards. So it's only while we're doing the live webinar, we'll put it on YouTube, and after that, we'll remove it.
Okay.
All right. And just so you guys know, we will have another webinar related to foreign income and asset. And I know a lot of time, this time we start to wonder about all of that. So we're gonna discuss that subject matter in great details in March. So today is February 8th. We'll probably do it about 1 month out. So maybe around March 8th, maybe around that date. So whatever I'll finalize the date and you'll see it on sanjeevcpa.com and you can register for there. So all your foreign income and asset questions, save it for that webinar. I think you guys are going to find it very, very helpful. By the way, if you don't mind, while we are waiting for everybody to join in, if somebody wants to post your questions, you can put it in Q&A section. So you're welcome to put there. And then if you have a comment, something you want me to talk to Sanjeev ji about, something that is bothering you, something that is a major issue, not a question, but just generic kind of a comment, then please put it in the comment section. So you have both. I hope it allows you to put it in the chat section. And if you have a question, then let's put them in Q&A, because if you put them in Q&A, that allows me to make sure that everybody's questions get answered. So that's the main benefit of that. All right, guys, let's give everybody some time. So how much time does it take to typically tax law changes to take effect, and is it retroactive? So Paras bhai, that's really most of the time they're not retroactive. Most of the time they will be for the current year. So whatever policies Trump administration comes up for 2025, they will be in 2025. But sometimes there are some minor things that can be made retroactive. For example, bonus depreciation for those of you guys who invest in real estate and whatnot. Trump can certainly make it retroactive for 2024, but most of them, majority of them will be applicable to future years, not for the past years. Okay, it looks like I already got a question about day trading. So remember, guys, I'm and Sanjeev ji is always very open to help out on individual tax questions, and we'll try to cover as many of them as possible towards the end of the webinar. But our major focus today is going to be on preparing for your 2024 tax filing. That's going to be the majority of the focus. And we will certainly talk about what is Trump planning for 2025 as well, but we're not going to focus too much attention on that. So please feel free to bring up your questions and put them in Q&A section. Another thing, if you don't mind me saying, is if you put the question on in Zoom. And if you don't really put your name there, if the questions are showing up as anonymous, then the problem I have is if 20, 30 people are typing the questions as anonymous, now I'm not really helping multiple people. I'm just trying to do a tax consulting for one person. So please, instead of just putting anonymous, if you can just put your name, that will be very, very helpful. So all right, looks like a lot of people are starting to join in, so we will get started and let people, you know, trickle in as they come along. But Sanjeev ji, first of all, thank you so much for taking some time out from your busy schedule and doing this webinar with us, because I think a lot of people are going to find big value in it. So many times, people when they come for tax returns, especially when they come in the month of March and April, they whether they come to us or they go to other tax professional, it's the same problem. And the problem is that everybody's busy. The tax professional is busy, the tax firm is busy, even the IRS is busy, and then you are trying to ask all bunch of questions that takes too much time. And tax professionals cannot pay enough attention to your tax return. They are just spending a lot of time in answering some basic questions. And we are trying to avoid that by doing this webinar and helping you guys better prepare to file your 2024 tax return. So I think if you're our client, you're certainly going to benefit from this webinar. If you're doing tax returns on your own, you're going to benefit from it. Or if you're doing it with somebody else and they are not providing you this kind of help or support, then I think it will be helpful for you as well. We will certainly appreciate if you become our customer. So we have 4 offices in California. So as you guys know, Sanjeev in California, he has 4 offices there. I'm personally in Texas, in the Austin market. So you have, you got coverage in a lot of different places. Sanjeev ji provides personalized consultation in all 4 offices. And for that matter, even if you're not out of the Bay Area, maybe you're in LA market or international and whatnot, and you want to connect with Sanjeev, you can certainly connect with him via Zoom as well. So that's another option for you to speak with him. Um, so some people are saying that they're not able to register. Yeah, they can't register around because webinar already started. So like I said, you can if you're trying to still log in, you can use the Zoom link that I have put up, or they can go to YouTube Live and then and join from there by clicking on the Zoom link from there. All right, Sanjeev ji, if you are able to hear me, if you don't mind coming online, let's get started. So that way I start focusing on these comments and you start talking about what's going on in the tax world.
Yes, thank you, Deepak, for doing this, organizing this webinar. It has been always been helpful, and always you have been a great resource for my firm, and also been a close friend for us, for the firm for a long time. Thank you again for organizing this webinar at a short notice. Of course, it takes a lot of efforts to do this. Uh, Again, thank you for doing this. So with that, let's start, Deepak. Let's start, or we will wait for some more time.
No, no, Sanjeevji, let's get started because the problem is this, that you're doing this webinar in early February. I'm pretty sure we're going to have close to 100 questions towards the end of the webinar. So the more
So,
we delay, then you won't have time at the end. So let's start earlier so we try to help out as many people as we can.
okay, so let's start it. Let's start this webinar. So this webinar is based on documentation and update for 2024 as well as moving forward 2025. So it will cover as the information that we have right now for 2025. Also, everybody knows President Trump is selected for second term. He's doing a lot of things, uh, which I don't want to go into political arena, whether good or bad. But for our tax purposes, definitely we are looking into different things. Uh, so we're going to talk about some of them as we go into this webinar. Uh, but the major focus will be on documentation, like Deepak rightly said. A lot of times people do come at the end, uh, and they don't even see their envelope. They don't even open the envelope. They just bring the envelope of their tax document. It says important tax information enclosed. They just keep it in the envelope and bring it to the tax preparation guys at the end, or they do something on TurboTax online softwares. They don't understand those things. In fact, I keep telling my clients and everyone, if you do on TurboTax on any online software, I bet you can save taxes by at least 30%. Why? Because whatever you're entering, you're not understanding the things. And for example, home office, you can say I'm doing a business or an app development, but what TurboTax will do or any online software will do, they will start looking at your whatever expenses you're entering. They will take it to Schedule C, and with that you can write off a lot of things. Or you can put some charity deductions which are not valid. There's some documentation are required. Or you can put some kind of miscellaneous deductions, which is part of itemized deductions. Or you can put wrongly your stock information because again, there's several stock. Uh, there are different types of stock and stock options: RSUs, ESPPs, ISOs. The way you do it, for example, expenses on trading, all those you can do a lot of things on online software which are not correct, which are not legal. But you are since you think you are master, you can do it online with complex scenarios. You can go ahead and do it if it's simple, but if you have complex things, for example, you have multiple W-2s, multiple states, working in multiple states, working remotely, have rental income, short-term, long-term, self-rentals, have businesses, sole proprietorship, K1s coming from S corporation, LLCs, retirement distributions, unemployment compensation, capital gains in different areas, vast rules applies for stocks, cryptocurrencies, uh, foreign income disclosures, foreign asset disclosures. Then we have deductions, charitable mortgage loans, used HELOC loans used for different areas. Uh, of course, businesses, hobby business versus actual business, then passive losses, different areas of computation of passive losses, credits coming from EV vehicle credit, coming from solar credit, coming from some other areas, EICs and other things. So that's the real gamut of things that happens if you have a lot of things or if you have some of those things and very complicating matters. uh, Definitely it's always beneficial to connect with a tax professional and make sure that you do the right things. That's number one. Number two, to kickstart your year for 2025, it's always better to consult a tax professional and get the right advice, whether you're buying a house, selling a house, starting a business, doing an entity, uh, moving with W2, high W2 income, what to do, how to do things, what's your rules, how to go about what's your rules, all those things. You need to get proper consultation and set up that consultation with a tax professional. I do the consultation a lot. Every day I do at least 7, 8 consultations a day. Uh, and I make sure that whatever information I need to deliver to the person, definitely we try to give that information in the best possible manner. Let's start with this one. Let's start the webinar. So first thing is we're going to cover today is, let me see, get stuck here. Uh, Okay, so there you go. So whatever we have heard right now, whatever we're going to 2 days back, he went to the his Republican friends, and he gave some ideas on what he's looking for. Of course, we know it, but we just want to give an idea. I just want to give an idea what he's thinking about. He says no tax on tips. Of course, there are 4 million reported tips. Roughly 4 million reported tip. 4 million people report tips. Roughly $24 billion over 10-year period, as per IRIS. These are all numbers given by the IRS. Over 45% does not report tips. As you know, there are a lot of people take tips under the table. So 45% does not report tips. If they start reporting those tips, because now it is tax free, they will become financially stronger to buy homes, they will do a lot of things. They can travel, and of course the economy will benefit. That's the idea behind this no tax on tips, but it will be subject to FICA taxes, so only the income tax will be exempt, not the FICA tax. What about the state taxes? We don't know what's going to happen. But tax on tips definitely will be a big item. Uh, like I said, $24 billion. Have we accrued 2.4 billion is the amount per year. Then he says no tax on Social Security. Over half the people, half the retirees pay Social Security tax because most of them are lower tax bracket, so Social Security is not taxable to them. They rely on the Social Security administration to pay 50% of their cost of living. $100 billion will be lost in revenue if he says no tax on Social Security. Then he says no tax on overtime pay. Again, $355 billion reported in wages are overtime pay. As a result of this, if he says no tax, then it will come about $67 billion. $67 billion will be lost in revenue. And then the big interest loophole is not only looking at lower to middle class, but it's also looking at people who really make money. Is going to ultra rich people, investment managers, fund managers, and private equity managers. All those things, they have a carried interest loophole. Carried interest is a way where they get the compensation in the form of a share of profit, and they held it for 3 years, and then they pay taxes on that one as a long-term capital gains rate. He wants them to pay taxes at ordinary tax rate. That's a welcome thing. If he's targeting them, how will it? We'll see what happens there, but that will increase the revenue, tax revenue for and that more a lot of things which we just say no tax on tips, but Social Security maybe they will recover something from that said from that thing. Then he's talking about a salt cap. Of course, the salt cap is uh, we know that state taxes and property taxes we are living in California are limited to $10,000. He's talking about increasing the salt cap. Did not say anything about how much. If we get to hear this about when it may be increased from 10 to 20,000, but we'll see what happens here. And then he wants to keep the tax rates, which for individual tax rates in the same lower range from 10 to, if you see the 10, 15, 22, 24, 22, 24, 32, 35, 37, he wants to keep the same tax rate, does not want to increase the tax rates. Uh, Otherwise, if he does not do these things, coming 2026, the tax rate is going to climb by 3 to 4% for every slab rate. So that's what we have right now on the tax proposal by President Trump. So it will really benefit. It will really benefit. What will it benefit? We'll see. But we have lost a lot of things going. We are losing a lot of in revenue. That's why you see all those things that you're trying to cut down by federal workers here and there, trying to cut all those kinds of shaky things he's doing. So because that gives him money to do all those things which is proposing, as you can see here. Uh, I have some problem with this system. It's the next one. Let's see. Okay, so now let's look at the 2024 tax changes that happens.
But
So
Sanjeev, see, don't blame yourself. It's not a problem with your computer. The entire country is stuck on that topic right now.
good one, good one. But anyway, so let's talk about the 2024. The 2024 tax changes we know is the standard deduction for single person is to 40,600. It has increased by $2,000. Definitely increased by that one. Then we have married filing joint. The tax rate have changed. The merit filing joint is 46,000. Sorry, not 46,000. And what I'm saying, merit filing joint is 23,200, and single person right now is 11,600. So that's a welcome relief so if you're filing as merit filing joint, you will see some decrease in taxes for you. And then uh, the tax bracket, like I said, 10, 12%, the seven tax bracket we have, it will be the same thing. Uh, Going forward for 2025, the standard deduction is increasing more because it's indexed to inflation. So you can see in the 2025 also uh, gate changes. Again, we have to wait what he does with Tax Cuts and Jobs Act. Uh, Retirement plan contribution has been there's change. If whatever money you put in retirement accounts is 23,500, as everyone knows, you must be having 401k contributions. If you're doing solo 401k, then you have 23,500 as employee portion that has increased to that. Uh, the contribution limit for uh, of course, for 2025, it has increased to like at least it has increased to up to I think $1,000 for 2025. For people who are age 50 plus, there is an additional 7,500 you can put, so it becomes 30,500. 2024 contribution limit for IRA is the $7,000 for workers below the age of 50 and 8,000 for those over 50 for those over 50. And so that has increased. So we are seeing little bit increases here and there, but it's a welcome relief because at the end, definitely you can look into lowering your taxes with those limits. Contribution to IRA, Roth IRA, mega backdoor is an excellent strategy. One should look into that. If you have contributed to after-tax contribution, make sure that you have those information available. If you're doing the backdoor Roth, make sure that you file the Form 8606 with your tax returns. If you purchase the electrical vehicle in 2024, there are a lot of things when it comes to electrical vehicle credit, EV credit, we call it. There are assembly components. There is a locally being purchased, manufactured in India, in the US component, then the income limit component. Then also there's sub-component of what is the dealer, what is the manufacturing being done. So there are several components of getting the EV credit. So it made simplified. You need to get a form 50,400. That form is essential to get any EV credit. So if you bought a EV vehicle from a dealer, make sure you've had this form 15,400 from the dealer. If you don't have that form 15,400, whether you qualify or not does not qualify, it does not matter. You will not get the credit. So this form is very important. 15,400, which is a new form for 2024 and go moving forward. If you have foreign and if you're working in a foreign country and you get a Form 16 or you get a salary income from there, then your exclusion has increased from 120 to 126,500. For 2025, it is 130K. State taxes, a state and gift tax exemption definitely has been increasing over the years. It has increased from 12.92 million. So it has increased from 12.92 to around 13.9 million, around 14 million, let's say, per person. This is going to be sunsetting in 2026. It's going to go back to 7 million if nothing is being done with Tax Cuts and Jobs Act. We'll see what happens. We'll give you a snapshot of what is the provisions are sunsetting for 2025. Sunsetting for, let's say sunsetting means 2026. 2025 is the last year for this Tax Cuts and Jobs Act. Gift tax, and if you want to give a gift to your family members or friends, it's $18,000 for last year, and this year is going to be $19,000. It's an important strategy for tax planning. If you have a lot of wealth and worried about estate taxes, you should look into gifting provisions, how to start gifting to your kids and family members. So overall, you can decrease the estate taxes when time comes. You see certain for changes in the forms are there 1040 series. There are certain changes we see here, like there's a change in the filing status section. There's a new checkbox that looks for non-resident alien spouse or to treat to spouse as non-resident alien or dual status alien spouse as a US resident. And there's some change on the Schedule 1, some change on Schedule 2, and then there's a change on this Part 2 of the Schedule 2. Some different lines are added. Not many, not I will say, not to uh, not which not to worry much about those changes. Of course, there are certain lines, there's certain information that IRS is looking for additional explanation to those items being claimed on the return. So not much I see a changes on the 1040 form for 2024. Of course, there are new forms coming up for 2025. We have a very important form that is 1099-DA. This form is for digital asset reporting requirements. Remember, the IRS is looking into yeah, tying up the brokers and others to get information on the 1099 form so that they can find out, they can do the correct calculations of your selling and buying those digital assets, and is correctly reporting on the tax returns. So we have to, so they have this form 1099-DA for 2025, not for 2024. 2024, of course, you have to rely on the statements you maintain in Excel spreadsheets. You need to maintain that one and make sure the buys and sell. Coinbase do provide you the report for buying and selling. They're again, digital asset has become very complex, blockchain, other things. So you have to be really have meticulous records of buying and selling those, or if you're transferring or gifting, of course, make sure that there's a line that says on the 1040 that you did you transfer or gift or any kind of exchange or any kind of transaction you did with digital asset. If you have done that, please make sure that you mark that, check that box that says that line. Okay. If it unchecking that box will result in a lot of penalties. Then there's a new form for net operating losses for Form 172. Then there is 709. They want to want to bring that 709 form for non-resident, which are not citizen of the United States. So that's we have to see what is this. We know 709 is a gift tax return for residents, and but not for non-resident. We'll see what happens there. And they updated the form W9. Like I said, the form 15,400, which is required for EV credit. And then we have new form. If you're buying a short-term rental in California, this form is important, which is known as BOE 571 STR. That needs to be filed starting from first for 2024. The due date is May 1st, 2025, for this form. And this is like a personal property statement, 571L, that we have users in a business. They treat the STR as a business, so that's why they want this new form relating to short-term rentals, relating to uh, personal property that you use inside the short-term rentals, the appliances, the furniture, the other things needs to be reported here. So this is a new form that are there, Form BOE 571 STR. So let's talk about the document. Let's cover. I've covered the order update is there for 2024. Now let's look at the documentation, which is the main part of this webinar. What are document required? What things are important for filing the returns, and what things we miss, and what should not we miss? So the first important thing is the tax ID number. It should be properly listed on your. Make sure that you have the proper tax ID. If you have an IT number or your social security number, make sure it's properly listed on the tax returns. Uh, if you, in case you get a social security number which replaces the IT number, make sure that you use that as social security number and make sure that social security number is updated in IRS record. If you don't do all those things, if you file the return with the new social security number, the chances of the IRS not processing the returns are very high because they have not updated it in the system. It takes some time in the system to update it. Of course, you have to make sure your spouse full name, social security number or tax ID numbers and date of birth are properly reflected. If the IRS has issued a identification protection PIN number, make sure that is listed IP PIN, we call it on your tax returns, whether it's given to your spouse or to you or any dependent. It needs to be listed on the tax return. I've seen most of the time when people list their bank account numbers, routing numbers, and account numbers, uh, they generally not see that whatever they're listing is current bank account numbers. They might be just carrying forward that information from prior years, and they forget to update that bank account numbers and routing numbers. And what happens is it goes to the wrong account because they might have changed the banks. So you make sure that those bank account numbers and routing numbers are correct. And also your billing address should be current. So a lot of times I've seen that people, when they get a W-2, what the address on a W-2, they put it at the mailing address of that at the mailing address is equal to the address on the W2. And what happens is the IRS will not be able to correspond with you. You send notices, you will not get those notices. You might have intimated the USPS to deliver the mail to your current home address, but sometimes it does not deliver, or it gets lost in the mail. Things happens there. So it's always important that when we look at the mailing address, please always provide the current mailing address, and don't provide the mailing address which were you in last year for 2024. Otherwise, the correspondence will be you will not receive correspondence, and it will subject. We will get a nightmare or some notices from the IRS saying, "Hey, we are not able. This is like a delinquency, or you have to appear in tax court." So on, a lot of things can happen, or they can put a lien on your property, something like that. So just make sure that you always put your current mailing address. Uh, Dependent information, make sure all the dependent information which is critical for child tax credit and kiddie tax rules regulations. Also, other dependent care credit information. If your parents are living with you or the kids are living or dependent on you, definitely you need those information. For claiming the other dependent credit on your return, make sure uh, uh, the parents do need to have a IT number for claiming the child tax credit. Make sure that the dependent should have your social security number. IT number will not work, and have have the right social security numbers. Make sure that not mismatching uh, errors are there on them. Uh, if the dependents are making any kind of income, of course you have to file the return for the dependent. It should not be exceeding the standard deduction to qualify as a dependent. In case it exceeds that dependent exemption, then definitely they will not cannot be claimed as a dependent. Anyway, the personal exemption is no longer uh, there since the Tax Cuts and Jobs Act of 2017. Uh, so it doesn't matter that way. But getting the right information is important. Not only from federal point of view, but also from California point of view. Remember, for California, we still have the personal exemptions to apply. So that is important to get the right information for your dependents, for your parents. Then we look at the documentation for source of income. The most important thing is a W-2. Now, when you receive a W-2, do check all the information on the W-2 is correct. And if you are working for multiple employers, make sure they're correctly putting the state. Uh, correctly putting the state in which you're residing, or they've taken the taxes properly out for the state of residence. If not, we have seen that a lot of mistake do happens if you're working with multiple employers. Uh, uh, what happens is they might not be giving the correct addresses, or the state tax withholding will be wrong. So you have to make changes or have documentation prepared as to why it's not matching with what is said on the W-2. In case of IRS gives you sends you notice, you are ready with that answer to that notice. So I'll check all the entries on W-2s. W-2 has a lot of information. It has contribution to HSA, contribution to retirement accounts, then we have FSA, dependent care expenses, credit for that one. Then we have RSUs, ESPPs, information listed there. It's like a whole form, which 1 to 20 boxes, and each box has a lot of information, a lot of instruction on that one. So a lot of times we have seen that W2 is not wrong, it's not right. So if you see certain information W2 is not right, you can always have call your HR, or if you work for, or the W2 from former employer is not right, you can connect with the former employer and make sure they send a corrected W2. And a lot of times you see the corrected W2 comes later, then you need to amend it and uh, and amend your return to reflect the corrected W2. If you're working in multiple states, uh, that's important because you keep moving from one state to another state. If that happens, remember you have to decide which state is your primary residence, which state you're having the connections. When you say connection, can be emotional, physical, financial connection. Which state you want to stay more, which state you have been staying more. You have to have proper documentation reflect that number of days that you spent in each state, so that you can proportionately allocate the the income to that state, and otherwise you will get notices from others from the state, and then it's a nightmare to respond to those notices for different states. So just have proper documentation of moving in, moving out from each state, income earned in each state, so that when you do your returns, you can allocate that income properly. There's certain state which give credits for tax for income tax in other state, for tax paid on income in other state. So there's a way you do get the other state tax credit on the on your tax returns 1040 on your state tax return on it. But there are certain state who gives, even if you're working in those state, the California, if you're in California, California do recognize the give the tax credit for those states. There are four states which are there. So if you're working in multiple state, the documentation becomes very important for properly allocating to different states. I've seen that for a lot of time people work in California, then they move to Texas. So the employer is still in California, they don't withhold the taxes. They don't withhold the California taxes, or they withhold because Texas is not subject to any taxes, so they don't withhold any tax on the W-2. But then they, because it's not properly allocated or not allocated properly, or they have not made mistakes on W-2, make sure that you properly allocate that on those things. If you're working remotely, that's another situation that happens. People do work remotely, and and the employees located in different state, but you're working remotely in a different state. Then again, there's a mismatching of W-2s and your state of residence residence issue. So what I will suggest in that case, if you're working remotely, an employees in different states, make sure that you do estimated tax payment for the state in which you're residing in, so that you're not subject to any penalties or interest from the state in which you're residing in. On W-2, if you're working with multiple employees, the most problematic area we see is excess 401k contribution. A lot of time people do forget to include that excess amount on the 1040. The system do tell you that there's excess contribution, but sometimes we don't even forget. We forget to include it. So if there's excess, make sure that excess is reported on the other income, not reported on W-2. So that line should be included. So these are the areas which are generally we see on W-2, general situation that happens. But there, like I said, W-2 has a lot of information. The whole 2 hours will not be enough to cover what is there on the W-2. So make sure, if the scenarios are complex on W-2s, a lot of things are, like I said, a lot of things are there. It's better to connect with the tax professional and get the right guidance. If you want to connect with us, we have, like Deepak said, we have four offices: Fremont, Sunnyvale, Pleasanton, and Tracy. And one number can connect all the offices, four offices: 510-825-7563. And we have 25 plus people working here. We are all the experienced CPA, CAs, uh, EAs working here, and they have been trained by me. Every Friday we do the training and make sure they're up to date with all the information. When it comes to if you're unemployed, definitely you get an unemployment statement from the state agencies, from federal and state agencies. So you have to report it on the 1099G do come. So you have to report it on their tax returns. It's not exempt. So a lot of times people do not get that 1099G because either they move to different state or they just forget about it. So, and uh, sometimes we have seen audits coming from IRS because they had not reported unemployment compensation just because they missed that document. So don't miss any document and try to pull up the documents from different areas. Remember, what I would suggest to our clients is, whatever happens in a year, just put on Excel. Everyone is good in Excel. Just remember, put on Excel, make an Excel for everything that you do, so that end of the year or beginning of next year, whenever your time is ready, you're ready for your taxes. You can look at that Excel and record what you did. If you are self-employed, definitely there are different 1099 forms. Your 1099Ks coming from credit card companies, the third-party vendors. If you are sub credit card, they will give you the 1099K. If you're working as a contractor for other businesses, you get a 1099 and EC. And if you have other income coming from different sources, then you can have 1099 miscellaneous. So you have to look at your bank statements. Basically, go through your bank statements. Make sure all deposits in the bank are tied in to the amount reported on 1099-K or 1099 MIS or 1099 NEC. A lot of times we don't even look at the bank statement, just take those 1099s, just report as sales. Uh, but there might be missed items too on the 1099. They might not have captured few items. So it's always better to go to your bank statement deposits and try to reconcile. The deposit might be coming from W-2 wages, the deposit might be coming from business income, it might be coming from any others, maybe a distribution you've taken from 1099 or maybe rental income. So you have tried to reconcile those deposits. I would suggest that if you're running a business, keep that business account separate from your personal account. Don't mix and match. Don't go commingle funds here and there. Try to make it separate. Now, if you do now we are talking about self-employed 1099 situation. We are talking about sole proprietor businesses, which is Schedule C. Now, a lot of time people say, I have a business. Uh, I do like to do painting or do like to do photography, but not much activity is related to that. This is passive. It becomes a hobby activity. So if it is a hobby activity, you cannot claim hobby expense more than the hobby income. But if you're doing actual business, what is actual business mean? Actual business means you need to have a business plan. You need to put money in the business. You should do something to get revenue, maybe buying computers, computer furniture, or something, or paying somebody to get started on this business. So there should be some kind of at risk, something at risk. Your money can be at risk, your time can be at risk. Uh, so there has to be some, and your material participating in it. You want to make it big. You don't want to just do a business just for the sake of uh, getting a tax write-off. And this is where people make a lot of mistake when they do their tax return online, because we have seen home office deductions, we have seen all kinds of expenses being taken on Schedule C and setting out their W2 income. W2 income. So make sure that you have proper business expense receipt. Make a receipt. Now, a lot of the people ask me, if I do a receipt, where should I store it? You can store it online uh, or in the cloud, and name it every folder. Name it for each year, and the type of receipt. Name it there. So I do it for my business. So I expect you should do it. If you use a credit card statement, make sure that you highlight all those expenses. Credit card statements is not a proof that those expenses are business expenses. It's just a proof that you made the payment, but not you have to prove that you are using that as a business expense. Any expense can, as long as it's ordinary, necessary, and reasonable, is a business expense. But proof is what you have to uh, keep for getting those deductions on in case any audit happens. If you bought any assets for business purposes like furniture and car or whatnot, definitely you have to keep proper documentation when you're claiming that depreciation. It can be 179, which is faster depreciation or bonus depreciation, or any kind of other depreciation that you claim. Make sure that you are having those receipt, or that if you're financing it, the yellow copy of a car becomes a valid document, and you have to keep it for n number of years. uh, Even after selling that asset or disposing of that asset, needs to give at least 3 years after from the date of disposal. So it needs to have that documentation. Generally, we say the receipt should be kept for 3 years. The statute of limitation from date you filed. But in case of this, when you take a depreciation on a furniture or computers or machinery or equipment, you have to keep it till the disposal of that equipment and 3 years later after that. So you need to have that built in. If you start a new business, all the startup cost, you need to document all the startup cost. Up to $5,000, you're exempted. If you bought a business through escrow company, all the escrow expenses, make sure that you're reporting it on your tax returns. And if you made any estimated tax payment, when it comes to estimated tax payment, we have seen that a lot of times people they mix up the payments. They might have made the payment for, let's say they are doing 2024, they might have made one payment in January 15, 2024, which can be for 2023. Or they might have made the payment for 2023 when they filed the return, when they owe taxes, and instead of uh, instead of taking that as a taxes owed for 2023, they might show it as 2024. And what happens when you do this mismatching of estimated tax payments? Uh, the IRS will send you a notice that this correction notice saying this, that you owe this much with penalty interest, and then you go back and say, "Oh, I made it, I did it wrong," and then you're subject to a lot of penalty interest. So just make sure that if you're doing estimated tax payment, those are meant. for a particular tax year, which is 2024. Then we have so then we have the other things. Let's see, my system is not properly working, I think. Okay. Now the documentation for important part like uh, rental income, sale of property. When it comes to real estate, we have a lot of things. A lot of things comes to documentation part. We have a rental income. When you say rental income is if you bought a rental property and put on rent, of course we have to look at your bank statement again. Make sure always go through the bank statement. That's a basic document for any income and expenses because that's what they ask for in audit is bank statements. So and also is a document that proves that you did something. That's the that validates all the income and expenses. So go to the bank statement. When you buy rental property, make sure you open a separate account for that bank for the real estate for rental property. If you have multiple rental properties, don't try to commingle. Try to open a separate bank. Opening a separate bank account, of course, is sometimes a headache, but it's important for tax purposes. The reason for that is if you have multiple properties and you're selling one of those properties, to determine the cost basis becomes a nightmare. So it's important that have a separate bank account or create an Excel spreadsheet for each property, matching with the entries in the bank statements for each property. So any expenses that you did for the rental property, like repairs, you did any travel, go to the rental property if you're located in different state, management fee that you paid. If you have a management company doing that management, make sure the Excel, the report that they give us, the report that give like management income and expenses, the report that they give to you is all it has all the income and has all the expenses. Sometimes they don't report everything. So or you might have more expenses than what they're showing on their profit and loss statement. So if you bought any rental property, make sure the same thing like we said for Schedule C, you have to have documentation as you bought a property to an escrow company, the escrow document, HUD statement, settlement statement, all the closing costs that you do and that you did for buying it should be reported, should be captured. If you have loan financing or if you are in a process of paying off earlier loan and taking a new loan, all will be mentioned uh, on the escrow document. What about the interest? Do capture the interest, do capture the property taxes. When you have a rental property, there's no limitation on claiming the mortgage interest like we have for primary residence, which is limited to loan up to loan amount of 750K, the interest can be claimed. But in case of rental property, if the loan is more than 750K, you can claim the full interest against the rental income. You can claim the full property taxes, which is limited in case of primary home. As we know, it's salt limitation, $10,000. Um, if you've done cost segregation, which is a very important strategy for wiping out your W2 income, uh, cost segregation is analysis of your depreciation of different items over different items which are used in real estate. Like you have land improvement, building the components. All the four items are different. Land is not depreciable, but other items are depreciable. They can they can shorten the period of depreciation. Then bonus depreciation do come into picture. If you have not got the bonus depreciation, not done the cost segregation, do that, and you can still file the Form 3115 to capture the missed the depreciation, and you can wipe out their income for this year. You can have if you built an ADU, accessory dwelling unit in your primary home. That's a way to capture the unused or not able to capture, not able to use the property taxes uh, belonging to that area, mortgage interest belonging to that area. Plus, you get rental income if you have somebody there in ADU living with you. Your parents might live in ADU. You might claim that you can have an office in that ADU, and then commuting, all those things will go off. Then business expense will be from the conveyance expense will be that as you move around from that place to any other place. If you did a solar installation on your home, make sure you proper documentation for that, the solar installation, the purchase order and everything. Make sure the solar installation is complete. Just not you made the payment and completion is done in 2025. If you've done 1031 exchange, make sure that document the 45 day and 180-day rule is properly done. You need to have a qualified intermediary to do all those things. That report is important. That statement is important. And if you're doing a short-term rentals, you have to keep proper record for the customer stay less than 7 days and proper record for your hours that you're spending it. If you're claiming as an active professional, like 100 hours requirement, more than anyone else working on the property. And what is those activities that qualify you? The activities is like closing the property, looking for the property, doing the improvements, doing the cleaning up, working, coordinating with cleaners, coordinating with management company, coordinating with tenants. You should maintain an Excel spreadsheet or with documentation, supporting document like a picture of what you're doing, emails, snapshots, a diary of the activity that you're doing. All those things will help you to determine the 100 hours. Remember, it's 100 hours more than anyone else working on that day, short-term rental properties or 500 hours. Uh, if you have multiple rental properties, multiple short-term rentals, it's very easy to qualify. One of your spouse can become active participation, and then you can do cost segregation. With the cost segregation, you can go into losses, and losses can be used to offset W2 income. Excellent strategy for doing that. In case of you have foreign property, definitely you have to, if you have a foreign property, not only you file the return in the foreign country reporting that income and expenses, but you also have to report that income and rental income and expenses on the US tax returns, capture that income. It may happen that in a foreign country, the expenses might be different. For example, if you have foreign property in India, you can claim standard deduction, one-third standard deductions, plus some expenses, but here you have to claim actual expenses. Here, the depreciation is much slower as compared to local properties, but then you have to capture that one. If you're selling property, remember there's selling a primary home, you get 121 exclusion, provided you stay 2 out of 5 years. You need to make documentation. What happens if you if you have a primary home, then you move out to a bigger home or put that primary home to a rental property? What happens then? Then 3 years from the date you move out, you still can get the exclusion up to $500,000 gain from sale if you're married filing joint. Uh, what about selling of investment property, rental properties? Can you defer any gains? Have proper documentation. Again, for selling, when you sell properties, make sure any improvement that you've done, you have document receipt for all those improvements. You have to go back to the bank statement again and highlight all the expenses. If you have receipt, well and fine. At least you can. But if you have bank statement, at least something can be given by the IRS if you don't have receipt, because you might have done improvement 6, 7 years earlier, and keeping the receipt for that time period might not be possible. But always try to develop a habit of keeping it in the cloud for years. When it comes to properties, when it comes to businesses, when it comes to any kind of activity, and that the carry forward losses is one way. If you have carry forward losses from prior years, maybe from rental property, maybe from stocks, maybe from uh, businesses, you have to keep record of that one because in case of audit happens and the carry forward losses coming from several years behind prior years, they will go to the source and find out why this carry forward losses happened, why the loss happened in the first place. So that is important. So when you again, what if you've done any kind of planning in this area? For example, you want to avoid paying any capital gains on the sale of property. You must have done 1031 exchange. You might have done qualified opportunity funds. Do document those investment in qualified opportunity funds. Do document the 180-day rule that we have from the day you sell, from the day you sold this, uh, from the day you sold the property or any other stocks, and there's a gain, and you put that money in qualified opportunity funds, you have 180-day rule. Qualified opportunity funds applies to anything, any gain arising from any stock, any capital asset, not limited to property. 1031 only applies to real estate, not to any gain arising from sale of stocks. And 1031 does not apply to gain arising from sale of foreign property in India. Then you buy the property here, does not apply there. Okay, so 1031, if you've done installment sales to have the spread the gain over a period of number of years so that you can take advantage of lower capital gains tax rate 15%. And definitely that installment sale agreement should be properly done, and should be reported on the tax returns in a different format. And if you are a real estate professional, make sure you have 750 hours requirement, which is important. You have to document the 750 hours that you're managing it to become a real estate professional. Real estate professional, by the way, is the best way to save taxes. So if both spouses are working on W-2, maybe you can do on the weekends or something. You can coordinate, buy a couple of rental properties, and it's very easy to qualify. But the problem with real estate professional is 50% of the time, or the total time, should be invested in that real estate. So if you have two spouses working together and working in the real estate is 25%. You don't have to prove per person. As a family, you have to prove it 50%. So it's still manageable if you have multiple rental properties. Uh, and you can if you become a real estate professional, then definitely the benefit, like I said, is tremendous. You can always have business expenses. You can hire your kids which are smaller, like under age 13 or to under age 18, or maybe older kids 24, give them payroll. You can use that money to pay their college expenses. You can use that money to invest in a Roth IRA, grow that money. So it's a best strategy for those areas. So definitely you can deduct home office. If you're not a real estate professional, like I said, for short-term rentals, is a perfect example where you can use that short-term rental to set up W-2 income through the. Of course, you have to meet that standards of 7 days regulation for customers, and of course, you have material participating. There are there are 7 tests, but I will say material participation is proved if you put more than 100 hours, more than anyone else on that property. And remember the new form that we have for BOE dot 5-571 STR. That's due date is May 1st for 2024. So that needs to be filed. Uh, and short-term rental, the another way is cost segregation. Like I said, like I already told you how to get faster depreciation. Now with President Trump, this year, the bonus depreciation this year is 40%. Last year it is 60%. If Trump changes any changes for this year, it can have a retrospective effect for prior years. That's why you might have to amend your returns or wait for things to happen, file an extension and see what things happens. In case of retirement, if you take any and if you're contributed to any IRA or DB defined benefit plan for businesses, or if you have taken money out from those retirement accounts, you get a 1099-R. By the way, 1099-R form is a very complex form. It's most of the time, the institutions do it wrong because there are several boxes which are conflicting to each other. For example, ordinary distributions, taxable amount, uh, tax not determined, capital gain not determined, the code for the various codes for distributions, state reflect information. So it has a lot of things which are complex. So when you get this kind of form, 1099-R, look at that each entry in that form. If it doesn't make sense, connect with your professional, make sure that you do it right. If you take money out from one IRA retirement account and then put it in another retirement account, you get 60-day rule. So that documentation is very important. Because when you pull the money out from one retirement account, you will get a 1099-R for that from that brokerage company from where you put that money, where you pull the money out. But you will not get a 1099-R from the other company where you put that money in, but you'll get a Form 5 5498 from the other company. By the way, 5498, some brokers do it, some brokers don't do it. Some brokers put it online, so you have to remember your account. Like I said, always maintain an Excel spreadsheet, whatever activity you're doing during the year, so that at the time of filing return, you can refer it back to the Excel spreadsheet and you can capture everything there. So lot of times, like I said, a lot of time people just say just the banks, the other they just put it on online. You have to go to your account and you can pull up the tax statements. They don't even intimate sometimes, but it's there. But you forget because you have a lot of activities. So just make sure that you just recall if your memory is good. Otherwise, like I said, go to the Excel and pull that information out, like I do for myself. Now, if you pull that money out from retirement account for some kind from medical emergencies or for emergency life saving, emergencies or something for support services, definitely you can waive the penalty. There's a penalty waiver 5329 form that we use for penalty waiver. You can avoid the penalty on that one, but again, you have to document the reason why it's going to be penalty free. Remember, penalty applies if you take the retirement 401k accounts or any other retirement account before age 59 and a half. After age 59 and a half, there is no penalty. If you do a rollover from 401k to rollover IRA, there is no penalty. If you do a conversion from rollover IRA to Roth IRA, definitely you have to pay taxes, but no penalty. When you do that conversion, okay, the same rules applies. You have to have documentation for those conversions so that you can capture the right way, all those things. If you contribute to backdoor Roth, like I said, 8606 needs to be reported. Uh, Contact your employer for after-tax contribution. You can put up to $69,000 for 2024 uh, with after-tax employer contribution. Total 69,000 per person. If you're age 50 plus, you can do 7,500 more, and you can also do backdoor Roth. So you can see how much potential is there to make the money grow tax-free if you use everything. You might get a 1099 SSA from the Social Security, or you might have got some kind of a disability income. So all these things are that forms needs to be taken into account. And if you're running a business, if you have S corporation or C corporation, you can set up a DB plan, defined benefit plan, where you can put in whole lot of money, maybe around 300K or more. You can still do the defined benefit plan for last year, this year. So if you have a business which makes a lot of profit and has no employees, you can do a defined, you can set up a defined benefit plan even this year, even this before the filing return, even now for last year, and save a lot of money. Um, if you are having a sole property based on the profit, if you're having a S corporation, LLC is based on net profit. In case of an LLC is based on net profit, in case of S corporation, based on payroll, how much payroll you run. But you can still do it for this year. So you can still do it for last year, this year before filing return. So you can do that DB plan if you have a business. Then, of course, the usual one, if you have get any 1099 interest statement, interest on the CD that you might have put in, or you might have put the money in say a money market account. A lot of times people have put money in a treasury bond, short-term treasury bills. So I've seen millions of dollars being invested in short-term treasury bills. The reason for that is it gives good rate of return, plus you don't pay California taxes on that income. So a lot of times you invest in that, so you will get a 1099 interest statement. If you get a dividend from stock investment, there are a lot of companies they pay qualified dividends, a lot of dividends, and those dividends are most cases are qualified dividend, but they might be ordinary dividend too. So you have to look into that. Uh, if you have foreign investments in mutual funds, uh, or you have any kind of foreign investment stocks, make sure if they are paying dividend on it, you make sure you declare that dividend. What about insurance policies? The dividends are not captured when they pay in because it's getting invested in premiums. But when you withdraw that money, then you have to compute the dividend at a time of withdrawal. And if you're invested in mutual fund, definitely foreign mutual funds, definitely we use the Form 8621. So you have to look at the broker statement. You have to look at your the net asset value, beginning and ending, and what you did, and that will be an important document for reporting on the Form 8621. If you have foreign asset more than 100,000, definitely bank statements and other documents. We'll cover that in one of those slides when time comes for that. Uh, Let me take a break from here, and then I will be back in 5 minutes.
Man, I don't know what kind of Chyawanprash Sanjeev ji eats every day. It's like talking that long for this kind of matter is just so difficult. All right, so I see you guys been putting in a lot of your questions in the Q&A section, so I like that. But once again, I want to remind everyone, some of you guys are using anonymous in Zoom. And if you put them in anonymous, I don't know if that question is coming from one person or same person is just trying to get a tax consultation. So, I would strongly recommend that you put your name in there because I'm going to prioritize people who are putting their name instead of people putting anonymous comments. So please understand my limitation there because I want to be fair to everyone. I want to give multiple people opportunity to ask their questions. So if you can take care of that, I'll really appreciate it. Yeah, I'm thinking about answering some of your questions, but then I'll lose track of, you know, who's is answered, who is not. So maybe I'll just wait till the end. And some of these are like, for example, Arvind Bhai is asking, I do a day trading in stocks, but get hit by watch sale rules. I want to know what to do. I need to do that so I can claim the watch sales. So, Arvind Bhai, for example, if you're doing day trading and you are considered a trader, I would strongly recommend that you set up a consultation appointment and properly understand how you can set up trading as a business. And then you will be able to take advantage of some of these flexibility when it comes down to investments. So, not a quick answer, but because if you don't do anything, then obviously you're going to get hit with watch sales rule. But if you really want to take advantage of, setting up a proper business entity and write off certain expenses and treat it like a business, then there are some opportunities. But that's not a quick answer. Strongly recommend that you set up an appointment. And let me see if what's going on YouTube. Are there people? Oh, look, looks like a lot of people on YouTube as well. And there are a lot of questions here as well. All right, so we'll try to cover most of these as well. Let's see. So a couple of them I can answer. Okay, so one question is about pricing for tax filing. So that one depends upon how complicated your returns are. So I will strongly urge you that you reach out to the office at 510-825-7563, or you can go to sanjeevcpa.com and then you can join it. You can just submit an inquiry and somebody from office will call you back and they will give you a pricing on your tax filing. I live in India. Can you guys still help me with US tax? Yeah, absolutely. So you could be living anywhere in the country, and if you need some help with filing taxes in the United States, we can certainly help you. If you need consultation, that's you can set that up with Sanjeev ji as well. But if you just need help with tax filing, we can certainly help you with that. Deepak, you also do other webinars and a group. Can you give me a yeah? Obviously we do tax webinars and then sometimes I talk about market updates and stuff like that. So if you want information on that, I'll put a link in here. I usually don't promote it online just because, the group is almost full, but I'll put it here if you want to join that one. So in here I talk about what's going on in market, so you can certainly do that. And all right, let's see what else I can talk about here. Okay, biggest risk with investing in solar energy and tax credits. I'll take that again. I would prefer that if I had your name there, that would make my life a little bit easy. But there are a lot of risk, and that risk applies to all kind of investing. But specifically when you're investing because of tax savings, I think that requires a lot of due diligence. So once again, that one I will refer to a personalized consultation. I think this subject matter you can easily spend good 6 to 10 hours in properly understanding how to do it properly. So my recommendation would be to discuss that in private on one-on-one consultation. And Sanjeevji, whenever you're back and you're ready to take over, just let me know, please, because I wouldn't really know unless you tell me. Okay. Oh, there you go. I see him.
because we have to cover like a lot of things. It's very difficult in a 2 hour time to cover a lot of things, but my attempt, I will try my best to cover as much as I can. So again, coming back to this documentation for individual tax preparations. So important thing is this area is sale of stocks. That's why I stopped for 5 minutes because it's important thing for everybody in the Bay Area, particularly in California, when it comes to stocks. We have RSUs, we have USPPs, we have ISOs, uh, we have non-qualified stock options, we have stock awards, we have RSA, we have different companies. We have deal in options, we deal in we deal in trading. We think we are a day trader. All those kinds of things are there when it comes to stock trading. And a lot of people do a lot of stock trading for last several years. They have been doing this. One thing that happens is always people say they are day traders, but they are not. They are not a clear definition of a day trader from IRS point of view. The court system, the courts have different. Uh, they have built up a different system over each cases. So we have to really examine whether you're a day trader or not from facts and circumstance of each case. Uh, the main thing when it comes to day trader point of view is your livelihood should be dependent on that. If your livelihood is not dependent on it, you're not a day trader. No matter how much trade you do, what type of activity you do, how many numbers you do, if your livelihood is not dependent on it, you're not considered day trader. And moreover, why you want to become a day trader? If you become a day trader, you lose a lot of things. Everything will be counted as short-term gain. Need to close your books before the end of the year, square up your positions. There's limitation on losses. So why to unnecessarily complicate that matter? For the other point of view, when you receive ISOs, the grant document is important document. When you get any kind of options uh, or any kind of stock incentives, whatever the document is, always keep that agreement in place, which has been given by your company. That determines a lot of things: the vesting schedule, the strike price, everything. So keep that in place. You will get some forms from your employer, and that forms are 3921, which is ISOs relating to ISO, and form number 3922, which is ESPP. And this will really help you to capture the cost basis. Because remember, in case of RSU, if you get vested, it's reported on your W-2, and W-2 will show you that vesting, the income on RSUs, and it will show you on your pay stub. Look at the pay stub and look at his what information reported on W-2. Remember, also one thing one has to take into consideration when you look at the always look at the year-end pay stub that you have. The year-end pay stub will give you year to date information and try to match it with your W-2. That will be a reconciliation part for you. So to help you, the employer will give you this kind of form for ISOs or ESPPs. What about RSU? RSU, there's no form, but again, RSU get vest on your it shows on your W-2, and when you sell it, of course, the long term, short term depends on number of years you keep it. Generally, it's more than 1 year is long term. ESPP, again, that will be reflected on W-2. You get a tax statement of taxable income from your employer that determines the cost basis and length of period that you hold. What about ISOs? Again, if you do early exercise, of course, you have to make sure that you file that form with IRS within 30 days from date of early exercise to start the meter running for long-term capital gains. So 83B election form that we use, you have to file it within 30 days. And also when you do your returns for that year, make sure you also attach a copy of that 83B election. If you don't do it, you lose it. So that is important document. Then if you have again, you might be having a US employer working in a foreign country, you might got ESOPs and other things, or you might have come from foreign country to here and might have got options or stock related to Indian companies which are exercised in this country. Those things again will be subject to a lot of reporting requirements. Complexity will come because you might be getting a salary income in the foreign country, and you might also be reported here on your W-2 income. So there might be double reporting, but you can claim a foreign tax credit depending upon where you got that benefit and where you should report the benefit. So there's a direct tax avoidance treaty with a lot of countries, particularly India. So if you're getting taxed in India, you report it here, get a credit. If you're taxed in US and but you are in India and you work for a US employer and you get a W-2, or they don't issue a W-2, then you can't take it. But if they issue a W-2, then definitely you have to report it. Of course, remember the foreign earned income exclusions, benefit, and other things you need to take into account that scenario also. If you have any if you incur any expenses like margin interest and other things on your investments, of course you can claim a little bit of that on the miscellaneous items deduction, not subject to 2%, but it's not helping. It's not going to help you much. Otherwise, the Tax Cuts and Jobs Act have taken out uh, the benefit relating to miscellaneous deductions, which are not subject to 2%, which are subject to 2% is still there, but not subject to 2% is still taken out. So you don't get that margin interest deduction, the brokerage fees, other things, the financial planner fees, nothing you're allowed to deduct. Do a business instead of doing this, maybe form an LLC for managing that trading account, and then you can charge a there's way out. There's a planning tool that you can use instead of going to day trading status. There's a workaround how to do it. If you want to connect with us, we'll work with you to make sure that you take the benefit of it. And then cryptocurrency, like I said, transaction involving cryptocurrencies, keep a proper documentation record of all those things. Uh, I don't want to go into that logistic of crypto because it will take a whole lot of time. And then we have documentation for other income. Like if you have won money, if you have got some gambling winnings, you will get a W2G. Uh, but what happens is you get a W2G, but you don't have a record of how much you lost. So again, when you are in that gambling mode, keep proper record of how much you lost. That will be useful when you get a W2G because you can offset the losses to the extent of income. Uh, any royalty, if you get any royalty on the something you're writing or something you created something which you get royalty, of course needs to be reported. Look at any other 1099 that you might have received. Uh, if you have a record of any alimony paid or received, need to be included. State tax refund. Uh, it may be important for other states, may not be important for California because yeah, in 10,000 you have to determine which 10,000 you've used. If it's a is a proportion of state tax or property taxes. If you have that one or use the state tax more than the property taxes, then definitely you have to prorate the state tax refund on your California return. For deductions, we have documentation. Home ownership is one thing. Mortgage interest deduction, you will receive a 1098 statement from the lenders that will show how much reported, uh, how much in interest that needs to be reported. Of course, they will on 1098 they will list out the property, they will list out the name, make sure the name corresponds to the title ownership or the name correspond to your name or your correct name or spouse name. What happens is there's multiple people on title or some different people on loans, so you have to work with those things. So you might have included your son, you might have included your friend, or you uh, might have somebody else on the title or somebody else on the loan. So the thing is, the interest can be claimed by a person who is making those payment and staying in that home. So it's those two things are important. And the loan amounts cannot exceed more than 750K for taking any mortgage interest. That 750K includes any kind of equity line of credit, any other credit that you use, which are used for home acquisition expenses, acquisition debt, not for any other purpose. If you borrow money from your equity line and invest in stocks, or you borrow money from your equity line and invest in other properties, the interest on that will not be allowed here, but it will be allowed in different schedule. So there's a concept of equitable ownership and beneficial ownership. Okay, equitable ownership is somebody else is living in that home, but that you have to show, we have to have documentation saying that he or she can claim that interest because they are making the payment, not you making the payment. So that is important. And what about mortgage deduction? You pay any mortgage deduction, EMI for a property in India, you can't take that.
because they're withholding tax requirements. You're making payment to a lender who is non-resident. You need to withhold taxes 30%. A lot of times you don't even do that. Okay, and how can you claim the deduction when you don't withhold taxes? So that's contradict those scenarios. Uh, if you done any kind of improvements to your home, like energy efficient improvements or residential energy and residential, like solar installation or any kind of water heaters and all those things which qualify for energy efficient home improvements, that have proper receipts for those one. If you don't have receipt, you can connect with the company that contractor that did the work and get the receipt from them. Uh, all the other 1098 forms, you can look into that, make sure that you're reporting for home ownership part and claiming those deductions. A lot of time people miss it. Charitable deductions, again, it has 60% rule and 30% rule, 60% for cash payments, 60% of AGI, you can do up to 60%, you can do all cash. You need to have receipts more than 250K. If you do in kind, this 30% of AGI, qualified charity in kind, like goodwill. I've seen a lot of people just take the goodwill receipt and give it for tax preparers. No, you have to put the value. Value needs to be put on that goodwill receipt and certified or signed by the person who's taking those things, and it should be validated. If you do in kind donation more than 2,500, you need you need a proper documentation 8283, and if you have more than $5,000 in kind donation, then you need a qualified appraisal. So those things needs to be taken into account when you do charity. People do forget about including the charitable miles deduction that you can claim. Make a log of your the miles driven back and forth for charity purposes, for even for medical expenses. If you're driving back and forth for medical expenses, that medical mileage also it can be used for a deduction part of it. Uh, but for medical expenses, like medical expense generally don't qualify in most scenarios because the limit is very high, 7.5% of AGI. If you're making $500,000, 7.5% is around 40,000. So medical expenses should exceed 40,000 to make any impact. So medical expense include any kind of medical insurance premiums you pay. Uh, of course, the IRS has big list of qualified expenses, not qualified expenses. I don't want to go into all those details. Remember, the main thing here is the medical expense should be those expenses which is important to maintain your lifestyle, uh, not trying to reduce your weight or something. That is not the medical expense. Not they don't generally don't allow. There's other cosmetic things which are there, which are not allowed. So it's a whole list. But remember to document those expenses. If you're using an HSA plan and using that money inside the HSA to pay for qualified medical expenses, to document that one as well. Uh, Health insurance, if you're taking a health insurance from a private marketplace, you will get a 1095A statement. Remember, in California, everybody needs to be insured, um, either from themselves or from the employer. If you're not insured, you're subject to penalties. So that is important for California residents. So that 1095A, it can be C also, 1095C also. So it depends upon where you're taking where you have you got this covered California from marketplace or third party vendors. You definitely need to, if you get that form, if you don't get the form, do connect with them, get those forms. If you did any childcare expenses for your kid, make sure you keep documentation, make sure that the daycare provider is licensed and you have a social security number, and whatever payments you're doing, have a record for all those expenses. You can claim credit, child tax, child dependent care credit. What happens if your parent provide that services? You can of course look into that planning area. You can see what you issue a 1099 or W2 to parent. It can be a household employee. Again, you need to look into it from the point of view of medical coverage for them. So you have to reconcile things and make sure which is the best one for them. If you're doing any payment for educational institutions, you will get a 1098T. A lot of times the 1098T is wrongly mentioned, is done in the name of the student instead of the parent who is making the payment, or is done in the name of parent instead of student. So it depends on a lot of scenarios. To claim that student loan interest deduction, to claim those uh, qualified educational expenses for claiming the AOTC, American Opportunity Tax Credit, or lifetime learning credit, the forms are important. If you get any scholarship or grant, of course, there's exempt in certain categories, depends upon other things, but that is important form. You also need to document, have a receipt or cancel checks for the payment made to educational institutions. And if you paid interest on loan 1098E, will be the form that we use. Student loan interest has a lower AGI limitation, lower AGI, so most of the time you don't qualify for $2,500. But again, there's a workaround. You can have your business, hire your kids, and definitely they can make the payment through that and get a credit also, get the deduction for that one. Then state and local tax payment, any payment, again, for California, it doesn't matter for now because you have SALT cap. Hopefully, President Trump will do something for us. For retirement saving, I told you 5498 is an important form, which shows all the contribution and the market value of the account. If you're living in a federally declared disaster, like what happened in LA, so you can claim those deduction for those areas, but you have a specific regulations for those the federally declared disaster areas. You need to record to support the property losses, maybe appraisal, the cleanup cost, repair cost or rebuilding repair cost, insurance reimbursement claim to be paid, FEMA assistance information. Always check the FEMA website to see if your county has been declared. If not, you will not get the deductions. HSA is important. You can still do HSA for this year, for last year. This year, what you can do for last year before filing the return, you can do defined benefit plan. If you have good profit, huge profit in businesses, you can do HSA plan. If you're not covered through your employer, the maximum limits. If your family, you can put up to I think 8,550 is a limit for 2025. 2024 is 8,300. So you can put that amount into HSA. That's the total amount allowed. HSA is the best strategy because it helps in three ways. One, it grows tax free if you use for medical purposes. You get tax benefit when you contribute, and you can invest HSA the way you want. You can invest in stocks, you can invest in bitcoins, you can do anything. So why not do that? Only thing is you need to have a high deductible insurance plan, and the plan has to be HSA compliant. Those are requirements for HSA, but you can do it for last year before filing the return. Of course, remember the IRA contribution, you can do it. If you have not done the backdoor Roth, you can still do it for this year, for last year, before filing the return. Remember the dates and there's AGI limitations for 2024 and 2025. We use the MAGI calculation for contribution, whether it is phased out or not phased out. But generally, if you are making more than $240,000 in most cases, you can't, filing joint, you can't contribute directly to Roth IRA, but you can do backdoor Roth in that scenario. If you want to contribute to IRA, traditional IRA for pre-tax, the income limits are very, very low. Of course, then we covered the child. We already covered the CTC with the child tax credit this year is up to 2,000 per kid, with 1,700 being refundable credit. Non-refundable is 300, and then child and dependent care credit is $600 and $200. Savers credit. So if you run a payroll for your kid for your business, and they invest money into retirement account, you do get some saver credit for them. It depends on depends on the filing status. The savers credit is going to become much slower in the years to come because they are looking to take it out. The ARTC, you get 2,500 per student for tuition, activity fees, books, supplies, and equipment during the first 4 years of college. It's during the only first 4 years, ARTC. So again, it's partly refundable, partially non-refundable. It's limited to $1,000 refundable, $1,500 non-refundable. Again, depends on the qualifying limits. AGI less than 400K does not qualify by filing joint. And the workaround is you need to run payroll and things like that. New changes for 529 RMDs, which is Sequoia Act 2.0 listed out. The retirement age has been increased for RMD. RMD is a required minimum distribution if your retirement accounts. If you turn age 75, this year, April 1st, then you have to take R&Ds equal to around 3 to 3.25% of your tax deferred retirement accounts. If you don't do it, the penalty is huge. If you are investing money in 529 plans for 15 years, and that balance in those accounts is 35,000 or more, you can roll it over to Roth IRA one time during your lifetime. Okay, so that's another benefit you can get, because a lot of time people invest in 529 plans and they don't use it for educational purpose, or they keep putting 89,000 or 17,000 or 90,000, the yearly limit for gift tax, into 529 per kid. It keeps growing because it's a state plan. It may grow something to 4 or 5%, but it keeps growing, accumulates more. But hey, you are not able to use it. So how to use it? Well, you take a distribution, pay penalties. But the Secure Act 2.0 had allowed 35,000 to put into Roth IRA during one time during your lifetime. So the age limit has been increased for RMDs is 75 if you're born 1960 or later, and it has reduced the penalty for missed RMDs from 50% 25%, but still 25% is a big penalty. So if you are age more than 75, make sure that you do RMDs, take out RMDs every year. Otherwise, the penalty is 25%, maybe reduced to 10% in certain cases. Some sunsetting provisions are there for 2025. We already talked about individual tax rate, the business taxes. Remember, the C corporation is 21% with the Tax Cuts and Jobs Act. It will come down, it will move up higher if nothing is done. But President Trump is saying to lower it to 15% for people who are manufacturing product in here in the US. Let's see what happens. We already talked about individual tax rates, standard deductions, and all this. This is going to sunset for 2026. So if nothing is done, so 2026 will be a new year with a lot of tax regulation, but it's unlikely that is going to happen. AMT exemption, by the way, is also sunsetting. The QBI deduction for business owners, it will sunset. Bonus depreciation will sunset. Estate taxes will sunset. So these are some of the provisions which are there for sunsetting for 2025, which we are looking, and we'll provide more information as things become clear from President Trump's point of view, what he's trying to do. I think he's going to tackle these tax provisions maybe in later part of the year. That's not because it's a very delicate matter. You need to balance out everything from where the money is coming in and where the money is going out. So there's a delicate balancing. You will not touch it right now. Maybe he will give some flyers here and there, but that will be lasting in his list. For business owners, remember you have to look at your EIN letter. Make sure the EIN letter is correct for the entity that you are having. If it's a general partnership, it will say general partner. If it's a single member, it will say sole member. The EIN letter is, if it's an S corporation, a lot of time people make this mistake. They think they form an S corporation, but most of the time they are not S corporation. So in that case, you file the wrong returns. You file S corporation, but they are not S corporation, they're C corporation. So the Form 253 needs to be filed. You need to prepare proper statement, financial accounts, profit and loss and balance sheet. Balance sheet is very critical for businesses. A lot of time people just put in Excel and dump it on the tax returns, their corporate returns, without realizing the impact of the balance sheet. Because if you have to sell the business or you have to dissolve the business, the equity, the liabilities needs to be determined, or you merge the business, those things will come from the balance sheet. Balance sheet is a barometer of the financial health of a company, and a lot of times people mess with those balance sheets. They know the income expenses, don't know anything about the balance sheet. So a system like QuickBooks is great. Just putting in Excel or Quicken will not solve. If you're using credit card statements, make sure you reconcile those statements. Payroll, if you have employees, the payroll report needs to be submitted on time. Document all the time sheets and everything. Is the time incoming and outgoing. You capture that one. If you have a sales tax requirements, document the sales report are important. The system that you use for reporting sales tax are important, because if you get audited by the sales tax department, they will look at the system and make sure it's reconciling. Estimated tax payment for C corporation. In case of S corporation, do pay a particular attention to basis, because that will allow you, if there are losses, that will allow you to offset losses. The basis can also reduce your tax liability when you sell the business. there's a reasonable compensation. Do make sure that you take out reasonable compensation for S corporation. When you're an LLC, you don't have to take out reasonable compensation because remember, the profit in case of LLC are subject to self-employment taxes. Uh, Entity status, like I said, S corp, C corp versus LLC. If you dissolve any entity, do make sure that you file the final return. Just making a dissolution with the Secretary of State will not dissolve the will not will not give away your obligation. You still have to do the final return with the IRS and Princess Tax Board. BOI reporting, there's a lot of who and cry, a lot of mix, a lot of whether to do this, whether not to do this. It's better you do this. Don't wait for what is going on in the political arena. In case of beneficiary ownership report, just go ahead and do that. In case of ERC, if you have applied for ERC, you have to just wait. IRS is becoming slower and slower. But remember, 2025, 2021, if you applied for ERC for 2021, the filing date is March 2022. We are coming up the statute of limitation of 2025. Then California tax, PTE tax, if you applied for PTT, paid for PTT for California taxes, make sure your proper document for the cancelled check copies and everything. And you should have an election on June 15 to get the PTT tax credit. Statement information is very important. Keep that statement information in active status. Keep filing that statement information with your state. If you're formed in Delaware, make sure you file the Delaware return. If you're formed in Nevada, there's a filing requirement. Taxes is filing requirement. Keep your entity in status for doing valid business. For foreign asset reporting requirement documents, we need document like ITR, tax returns. We need a bank statement for foreign countries, brokerage account statements, Form 26ES and Form 16A, which are tax directorate source documents. Insurance policy, we need a cash surrender value. Foreign gifts, reporting the foreign gifts, gift document, gift deed, transfer, whatever transfer is done, check keep a copy of the transfer documents. Foreign inheritances, will, death certificate are important. Ownership in foreign entities, structure of the entities, what kind of, we need a balance sheet, profit and loss statement to determine 5471 forms, other things. And then we have an update on Indian budget. Indian budget, this year up to 4 lakh rupees. There's no tax for non-resident Indians. So that's a welcome relief. It's not 12 lakhs. Okay, 12 lakhs is for resident Indian and resident, but not ordinary resident. For us, it's 4 lakh rupees. But still, we save taxes. Let's say if you make 20 lakhs in India, we still save 92,000 rupees in tax savings. And they are given a time period to file our returns. If you file wrong returns, you have 4 years to update the return. But the main thing is we are going to tighten the tax regulation for non-residents, particularly the students and young professionals who are here in the US. They were looking at greater scrutiny of foreign earned income exclusion. They're going to expand residency definition for taxation and potential impact on treaty benefits. So they're going to tighten the rules and regulations. The Schedule FA, foreign assets, which are attached to the tax return in India, they want to make it they want to make it exhaustive and detailed so that they can look into that foreign income disclosure requirements. If you keep transferring money from here to there and don't report it correctly, they want to levy some kind of tax on the repatriation, on the transfer amounts, or they can send notices as to why you're transferring these amounts when you're not declaring on the Schedule FA. So this week, the finance minister going to present a tax reform bill. They want to simplify the language used in income tax bill. I think already is in the process. We'll get to know this week, and we are having a webinar come this March on the foreign income reporting requirements. We'll have more detailed information on what is going to be taxed, what is not going to be taxed, how to take advantage. A lot of people are thinking of going back to India. So there's some planning needs to be done in that area. So that is update on Indian budget. And with that, let's go back and for us, what services we provide? We do provide amnesty program services for people not declared the foreign income, foreign assets. We have been doing this for several years. So if you have not disclosed foreign asset or not disclosed the income, you can connect with us. We do provide year-end tax support and planning. Like I said, we have 4 offices, and all people working in all these 4 offices are very educated, professional, knowledgeable. We do support notices received from IRS, FTB, EDD, and our fees tax prepare starts at 450 and goes up, depends on the forms. And my consultation with the clients is $200 for 30 minutes. With that, let's go to question answers, Deepak.
All right, there we go. Sanjeev ji, you probably want to grab some coffee, tea, you know. Man, that was a lot. So what I'm gonna do, guys, is I'm gonna take some of the questions from YouTube first because A, they're very simple and there are not that many of them. And then I'll go after your questions. We have almost have 60 questions here. So we're gonna have to go super fast. So please, if you have more questions, please put them in the chat. Like I said, I'm only gonna take questions from people who disclose their name. If you're just leaving the questions as anonymous, then I'm not gonna take them just because I don't want to turn this Q&A session into um, a consultation call, right? The idea is to give many people an opportunity to be able to ask their questions. So first question is about cash labor charges without receipts. So that one is very simple. I mean, you don't necessarily have to have a receipt. You can always have a statement from a vendor telling them that he did this work for you. And you can obviously have your bank statement and your check if you paid them or your credit card statement. But one thing you do want to remember is 1099 NEC for more than $600. Sanjeev ji, I think that you probably see that a lot, right? Many times people don't have receipts, but they have an expense. What do you recommend to those people?
Yes, see, the general rule is if you have receipt, if you don't have receipt, but expenses, there has to be, like I said, as long as ordinary, necessary, and reasonable, you have, if you don't have receipt, that's not the end of the world. You should have some support, some other documentation, alternative document, why you need a receipt, why you don't have the receipt, why this expense is important for your business. Maybe you can connect with the vendor, or maybe you can connect with something else, but uh, you have to maintain, the responsibility is on you. So you have to have alternative document to support that expense.
Okay. Another one, Sanjeev ji talked about federal tax rates. Are there additional taxes? Of course, there are always state taxes, there are social security taxes, there are Medicare taxes. So Sanjeev was just talking about the major changes that is happening on the federal side. Okay, mega backdoor Roth question. I think there are several, one of them those in Zoom as well. That itself is a big topic, guys, by the way. So, maybe I'll just quickly go over it, but I know every year we get a lot of people wondering about that. Okay, so question is, can you contribute to mega backdoor Roth before um, okay, mega backdoor Roth. Okay, so I think Sanjeev, I don't know. I don't think you can, right? I mean, that has to be done to the regular 401k, and then you can do the conversion. You can't directly put into Roth. I mean, any pointers there?
Yes, so it's based on the company plans. Basically, the company will determine whether they give you the in service conversion to Roth. So that will be determined by the company, not by. So there might be some company who provide that in conversion to Roth, but again, it's a employer plan.
Yeah, and for the most part, I think you can always just put the money in and then convert it a week later. So that's what we usually tell people. All right. I think that's about it here. So let's go to these questions on Zoom now. And there's like, man, that's a lot of questions here. All right. And my screen going to keep changing. So we already answered quite a few of them already. Okay. How taxes impact with death of spouse / next with the refinance closing cost?
Death of spouse?
Yeah, so I think, and this question is not quite clear here because,
Yeah.
well, like for example, you can obviously get step up in basis. Are you trying to sell the property? There's just so many things here. Like, what exactly are you trying to do? As far as, let's say, if something happened last year, then obviously you can still file that merit filing jointly, and then you go as a head of household afterwards for a couple of years. So that's a generic answer, but I don't know. Maybe there is property involved. Maybe you're inheriting something. So there could be a lot more things going on. My recommendation is anytime there's a major life event, best to do a personal consultation because there could be so many variables to there. Anything you want to say, Sanjeev ji?
Yes, yeah, because the question is not clear. It's What I think is asking is the expenses relating to refinance the loan or something or former spouse, expired spouse. So again, like was rightly said, inheritance is there, so it has to be. The question might not is not very clear.
All right. Another question is, my buyer is paying me 90 lakhs cash for my apartment sale in Mumbai. How do I get to US? Okay. So I think it's about transferring 90 lakh from Mumbai to US, Sanjeevji. I think, by the way, this could be for many other people who want to transfer the money. So maybe you can answer it in a generic way.
Yes, so transferring the money from India depends upon the source. First of all, we have to find the source. Where is this money coming from? Whether it's being reported. That's the important thing. Two important things. And then once this is the source is validated, the income is reported validated, then definitely you can transfer up to $1 million if you're a US citizen for Indian fiscal year. If Indian fiscal year starts from April 1st to March 31st. The bank do ask you for due diligence documents like Form 85, or they might ask you to fill out certain things. They might ask you for CA certificate. You also need to have a PAN number, another account number. All those requirements are there.
Okay. Next question is, please suggest if your office helped with filing transient occupancy tax returns. So it looks like a short-term rental gentleman here. So Sanjeevji, I think most people file that on their own, right? I mean, do you guys do it in the office as well?
The which one?
The transient occupancy tax return?
TOT. TOT
Yes.
returns. Sometimes if it's our client, we do it. Otherwise, generally people do on their own. But if they're our client, we do it for them.
Okay. All right. I'm renting my second garage, converting into an ADU, and applied for addition for a couple of rooms to the city. So can I claim the permit and related fee charges, architect fees, etc. in my taxes?
Again, these are startup cost, like improvement, like cost which adds to the basis. It will not be expenses per se. It will be depreciated. But like I said, if you're short-term rental, you qualify for that hours and everything requirements. You can do cost segregation analysis, and then that will benefit when you from your tax for your taxes. So yes, you can do that, but don't worry about the expenses. First, maintain that record keeping for being qualified as a professional for short-term rentals.
All right. How do we show 1099-Q from 529 for adult kids used for college tuition? Should it be filed by parent or kid? I guess depends who that 1099-Q was issued to, right, Sanjeevji?
Right. And definitely, mostly the 10Q will be issued to the parent. So if you use that for educational purpose, then it's all good. You have to use it. You have to use that form 5329 to claim the exemption from penalties. So that form should be used.
If a family moves back to India and has bank interest earning less than 10K earnings in US while being non-resident to US, do they still need to file taxes? Are they allowed to file jointly?
Well, if they are moving to India, and depends on what's the status is. I believe they are on H1, not citizen or green card holders. If they are on particular visa status and they move to India, they give up their status, so they become a non-resident. When they become a non-resident, there is no provision to file joint. You can only do 1040 NR, and then you have certain things you can claim, certain exemptions, deduction you can claim, certain things become taxable. Whether it's related to ECI or FDAP income. So yes.
All right. I think what he's probably wondering is because of the standard deduction. So even as a single standard deduction is 14,600. So if it's only less than 10K, you might not need to worry about that. But remember, it depends on, well, I guess you're non-resident, so that you're more than likely you probably, yes.
Non-resident, but still reporting is required for every dollar. Even though you don't pay any taxes, is below the limit. But if you make anything in the US, there's a requirement to file the return.
Are gifts to relatives taxable to relatives? No, if you're giving a gift to somebody, it's not taxable to the receiving party. All right. For gifts given to family back in India for maintenance, can that be used to offset something? Interesting. Remember, it's a gift. So what are you trying to offset? Maybe you have some other strategy going on. There could be a potential, depends upon how your stuff is structured. Maybe are you a business owner? Are they helping you out in business? So there may be a strategy here to play, but we don't know. Not based on what you have mentioned here. Okay, I'm retired, over 55 years old. How much can I gift my kids each year out of 1 million, please?
1 million, what does it mean?
I don't know. I think maybe he's residing in India. Maybe that's what he's coming up with, that 1 million number.
Not sure. The question is not clear.
Yeah, I mean, technically speaking, Sanjay ji, you can gift whatever you want to gift to your kids. The gift limitation, I think, is $18,000. Anything over, you have to account for out of your estate. But you can give 18, your wife can give 18, you can give your grandkids 18. So I'm not sure what this 1 million number here is. Maybe you have, maybe your question is something else. And by the way, that has nothing to do with your age either, right? So you could be 35-year-old or 50-year-old. Gifting is not dependent on your age. All right. If family moves to US in mid-year, husband moved in April to US more than 180 days, while spouse and children stayed in US less than 180 days, moved in June, can they file jointly as resident status? So one person is a resident, other people do not meet the resident status. What do you say, Sanjeev ji?
I will go ahead and file as a joint return because the dependency is based on the substantial percentage, of course, it needs to be certified. But since the primary owner is here, resident, or certifying this SPT, I will go ahead and file a joint return.
Yeah, and most likely that's the person who have probably majority of the income anyway.
Yes.
Will the dependent income get added to AGI of married filing jointly?
AGI for married dependent income will depends on if he's a dependent, he has to file his own return, right? It's not adding to the question might be that whether dependent income is added to the parent income. It depends. If it's a unearned income and it exceeds certain limits, definitely there's you have after $2,000 of unearned income, you're subject to you have to report it on the parent return. There's a form that we use. In that case, yes. But in other case, if you earned income, the dependent has to file their own return.
If I'm claiming my college going kid as dependent, but he made some money as part of summer internship and I want to claim my kid as dependent, how is kid internship income less than 12K is reported? So it's a very similar question here. So it's an earned income. So technically, like Sanjeev ji said, we recommend that they file their own tax return. And for federal purposes, obviously, he will be under the standard deduction. So there's technically speaking, he won't have any taxes due, but then we also have California. So I think based on Sanjeev, what said earlier, he should file his own tax return. Okay, what costs are associated in establishing and maintaining an LLC in California? What are the pros and cons of having an LLC? Oh my God, that's a big question. I mean that we can that's a big question. So I can give you some basic answer on it, but obviously I would strongly recommend for something like this, you do seek out a consultation with Sanjeev and talk to him in person. But basically, California charge minimum $800 a year, regardless of whether you make money or not money. Then there on top of that, if you did make money, there are some California taxes around that. There are some costs for setting up a company, depending upon how you do it, that could be a few $100s as well. And then there's some maintenance involved with it as well, right? So there are some costs with it. So you've got to be very careful before deciding that route or not. I'm assuming you're in California, but if you're in a different state, the answer would be different. How the property tax and mortgage interest gets claimed between the main house and the ADU. So I guess between their primary residence and an investment property.
Yes, based on the square footage of the area of the ADU, you can claim it based on the square footage. Yes.
Okay, how far in terms of past tax information we need to keep in years? Well, uh, that depends. If the tax returns are not accurate, then you should keep them forever. But if they are accurate, typically IRS likes to go back 3 years. Anything you want to add to that, Sanjeev ji?
Yes, like I said, if you had bought any asset like real estate or something, and this is rented out for years, so you have to keep going with that closing escrow document. Keep when you bought it for years till you sell it, and even after selling it, you need to keep 3 years. Or if you bought a car or something, or any other things that you bought that is still being used, or you have any losses, initial losses that has been carried forward, that the year that you have those losses that has to be kept forward till you use that losses. So there are things. So there's the general rule: 3 years from date you file it. But if you have those specific situations, you have to continue holding that document for years.
Are legal expenses to real estate LLC business tax deductible? Yeah, any business expense is deductible. How we deduct it will vary based on whether it was a startup expense or an ongoing expense. So there's a, we will account for it differently, but yes, they are certainly deductible. Can people doing consulting claim tax deduction without having an LLC in California for California and federal taxes? What kind of tax benefit deductions they can claim? Driving mileage? Oh my God. Again, this is really a consulting question. You really should seek out a consultation. This is not a platform to get tax consultation, please. All right, so I'm gonna skip. Looks like because they are all anonymous, so I'm gonna skip them all because I'm assuming they're all coming from the same person. And please, this is an abuse of this platform. Don't do that. I want to give opportunity to everybody else to ask their genuine questions. My wife's base salary is capped at certain amount, say 175K, but because of RSUs, it bumps up so much and unpredictable, unable to calculate estimated taxes to make payments on time. Sometimes we get the refund. Okay, I get the question. Look, there's no easy answer to it. If there are RSUs involved, you should work with your tax professional, let them know what the income going to look like, and they can calculate that for you and at least get you in a ballpark figure. So that would my recommendation would be, or you can use some online tools to get some idea, but there is no automated way. Sanjeevji, any suggestions you want to add to that?
So my suggestion will be, even if you are not there, I know understand the complexity. You don't know what you're going to get this year or any year based on RSUs, but that one estimated tax payment you remember is January 15th of next year. So whatever you have to compute after the end of the year, you look at your pay stub, look at your withholding requirements, and you still get that 15-day window to capture that extra taxes, so that you don't end up paying taxes and don't end up paying the penalty interest. So that 15 days, January 15 of next year there's a reason why there's January 15. So year end of pay stub is important, and you calculate and you can pay by January 15. You can avoid all interest and penalties.
All right. How long do you need to keep the bank statement for document purposes after the filing? Sanjeev, you already said depends upon what kind of expenses are we talking about here. Minimum is 3 years. Can you cost segregate for long-term rentals and get a benefit from your current W-2? Remember, cost segregation benefit. If you're getting a W-2, then most likely you are not going to be considered a real estate professional anyway. So that does not really benefit you. And you already said it's a long-term rental. That means it's certainly not short-term rental. So you don't really meet the requirement. Anything you want to add to that, Sanjeevji?
Yeah, you're right. Yeah.
Okay. Will the property tax be reassessed if you built an ADU? Any limitations on it? Any tax implication we need to be aware of for the building? I can tell you from my personal experience, obviously this is a county-wise question because each county, like sometime I will meet with clients where they say county haven't reassessed their property for like 10 years. And then sometime I'll meet where they get reassessments every year. So it really depends upon your county. Like, for example, I can tell you in California, they're really going through like making visits to properties every now and then, and they will reassess you if they see any improvement at the property. Anything you have seen in the market, Sanjeevji?
Yeah, you're right. See, we always think about few cents. We don't worry. We don't plan for a bigger sense. So the thing is, why you worried about property taxes, increasing property taxes? Increasing property tax rate is around 1.5% to 2%. And see how much benefit you're going to get on your taxes. If you're in tax bracket 30%, 40%, and you're able to you're able to claim the market interest and property tax related to that, how much tax benefit will you get? Why you worry about 1.5 to 2% increase in property taxes? That's for me, it's a no question on that one. If I can generate a proper deduction, let's say if my deduction increases by 20,000, 30,000, if your bracket is let's say 30%, I say $5,000-6,000 versus 1.5% on the increase in the property tax rate. I will not worry about that one.
All right. Okay. This is a question about installment sale. So again, that's a big topic. Generally speaking, when we have a large capital gain in a mostly we do it with properties, a large capital gain. Then one of the option is we can always spread out that capital gain over multiple years. But we got to do a lot of calculations. We need to see how much of a recapture we need to do from prior depreciation. Sometimes that makes sense. Sometimes that might not make sense. So if you have a property that have a large capital gains in it, my recommendation is reach out to Sanjeev and set up a consultation and go over it, because I think you'll be surprised. Many times it doesn't make sense, and sometimes it makes great sense. All right. I'm a US citizen with an OCI card. I sold some inherited agricultural land in India last year. Do I need to file income tax form in India or just add this information on my US tax return? Well, if you sold something, then you certainly should report it in India, and you definitely should report in US. Sanjeevji, anything you want to say about
Yes.
that?
So one thing I want to add to the earlier question on installment sale. Installment sale generally is useful in one area. If you think that your income this year is much higher when you sold a property, as compared to going forward years, future years, you don't see much increase in income, maybe due to you're retired or things like that, and then installment sale will help you with lower your tax overall. But that's like you rightly pointed, that will depend upon you have to see your things. Constellation is important. But coming to this question, definitely there's whatever you said is right. There's nothing to add on that onto that one. Yes.
See, Sanjeevji spills out so many beans. I was saving that for consultation call, and Sanjeev just gave it away. So Sanjeev is awesome when it comes down to sharing knowledge. Can you please elaborate on 180-day rule for QF investment and tax benefit to reduce taxes for stocks and related short-term and long-term capital gains? So, well, I mean, Sanjeev, if you want to go, because I have a lot more questions. Look, if I did this webinar live on YouTube, so maybe you can go back and watch the slides again. And maybe we'll just leave it at like that, because I don't want Sanjeev to go and repeat what he already discussed in the webinar. Should I contribute to 401k or Roth 401k? We recommend do both, right? But to really, if you want to know, the real ROI, then we got to do some math. For that, you got to do consultation. But in most cases, we usually recommend that you do both. Can I roll over my post-tax traditional IRA into Roth IRA to do backdoor Roth IRA? What are the steps and rules? Once again, we can talk about something basic, but you got to really do consultation on that as well. General rule is before you do any conversion, you got to make sure there's nothing left in your traditional IRA. Everything has to be converted. Otherwise, you run into prorate rules there. Sanjeev ji, any major
Yeah, it's
line
like
mile?
so. Yeah, so remember, traditional IRA can be, you might have traditional IRA with like few years back, you might have forgot about it. And suddenly you do a backdoor Roth, you open a new traditional IRA and but you still have that traditional IRA which you forgot. Now it is a problem. So always remember that you should not have any traditional IRA with pre-tax money anywhere with any brokerage companies. Okay. And you should not have any rollover IRA with any brokerage company per person. So if you have those scenarios, you can roll it back. You can do a rollover to existing company 401k plan, and then do this backdoor Roth. But remember, a lot of time I've seen that people don't understand that traditional IRA. They say, "Oh, I don't have a traditional IRA," but they forget about traditional IRA, which they have, and they have pre-tax money. Then this strategy will not work.
Okay. Wow. Too much info in short term. Thank you so much, Sanjeev ji, for your kindly educating us. Very generous of you. Yeah. Thank you so much for joining. Really appreciate it, Jay. Do we need to get ITIN for kids? Yeah. I mean, if you're going to, obviously claim them on your tax return as dependent, you certainly should get an ITIN. I'm not sure why would you not. Any reason why they should not get ITIN, Sanjeev ji?
No, no, there's no reason. Absolutely no reason.
Yeah. Yeah.
Because I think they will qualify for $500 other child dependent credit, other dependent credit for $500. Why not?
Yeah.
It's a big saving.
Recording available. So like I said, this is a YouTube live. I already said that. So I'm leaving it there for a little bit, but eventually I will delete it. So you can certainly go back. I'll probably leave it for the weekend. So that way, many people who wants to go back and catch on to certain things, they can. Slides, obviously it's YouTube. So slides are all obviously there as well. So no problem. A lot of thank yous here. All right. What do I do if I gifted more than 80K? What documentation is needed?
So the gifted more than 80K, of course, you have to file a gift tax return, right? If it's more than 18,000. That excess amount will be taken out from your lifetime limit, which is $13 million, $14 million this year. So you need to file a gift tax return.
Yeah, and then I mean, depends upon how much you did. Maybe you're married and maybe you give 18, maybe your wife give 18. So there are some scenarios there to play. But general rule is if it's more than 18, you got to take it out of your estate. They want to keep track of that. If you convert part of your home to ADU, how do you report earned from ADU in your taxes? So that just, I think that's what I don't know. He put JDU. I'm assuming he's talking about ADU.
Yeah,
Yeah.
it's a simple. It's a rental property, right? It's a
Yeah.
part of your home. Yeah.
All right. And please, if I'm reading it incorrectly or if I missed something, then you might want to let us know. But I think that's what you mean here. Do we have to pay tax in US on national pension scheme in India? Ooh, that's a good one, right?
Yes. Yeah, NPS,
Yeah.
of
So
course.
Sanjeev ji had talked about that quite a bit, many times. People get confused with, you know, pension reporting, related to FBAR and all that. But we're going to discuss all of those matters in great detail in March on the FBAR webinar. So we're going to really break it down and we'll look at all kind of different income. So certainly join that. So this is Shruti is asking about 1099Q. I think we answered that earlier already. So it's a repeat question. Short-term rental. Does the property need to be a second home? Can I buy within 50 miles? Short-term rental, you can buy anywhere. You can buy it. You can buy it in Hawaii. You can buy it in Alaska. It doesn't matter. You can buy it anywhere. So there's no restriction as to where you buy. And if Trump has it his way, you might be able to soon buy it in Canada as well. That's it. That's it. All right.
Maybe Panama also, maybe somewhere,
Uh,
maybe Greenland too.
yes, certainly Greenland. Or you can buy the entire Greenland. Why go for short-term rental? We are in that mood. Might as well, right? Okay. What is the
Now
benefit?
and I see the president, prime minister who are coming to this country to see him. Whenever they go for a press conference, they are worried this guy can say anything on their press conference.
Uh, uh, and then they can't say anything, right? They have to
They
just like.
can't say anything. They can't say, and this guy can turn around and say, "Okay, did I say it right? Will you say? Will you do it?"
Uh, okay, what is the benefit of putting money in post-tax traditional IRA? Well, the main benefit is you can easily do conversion, right? It's like a very easy way for you to build tax-free wealth. So you put it in a post-tax traditional IRA and then you convert. So Sanjeevji has talked about it many times. It's a great way to build wealth. I sold property in India in 2024. Can I file 2024 US tax return and claim credits for full India tax deducted at source before April 15th and then file an amended return after I get some of the TDS back from India later in the year? So Sanjeev, this is a very common question for a lot of people who do transactions in India. What is your standard procedure for this?
So first of all, I will not amend any return for foreign reporting requirements because that creates a kind of suspicion in the mind of IRS. So always recommended method is if you have foreign income and you're filing a return in India, file an extension for the US tax returns, file the return in the foreign country, and then based on the return, you file a return in the US. You don't have to amend. You don't have to file right now and then amend. No. The question that comes up always is, hey, I don't know how much tax to pay. Of course, you can estimate the taxes based on the income scenario. Uh, you can give us some 30%, 40% of based on your bracket, you can pay those taxes. It's only 3-4 months of investment, but I will take that risk rather than amending return, and the risk of amending return is much more higher.
Yeah, so you don't want to unnecessarily create a headache for yourself. That's the idea. And by the way, if you have something like that, honestly speaking, you really do need a consultation. Or at the bare minimum, even if you don't go for consultation, make sure you don't do this on your own. So that would be my recommendation. Question about real estate professional. Assuming both spouses have W-2 income, in regards to using 25% of time each spouse to add to 50%, do both spouses need to have real estate license to qualify as the real estate professional? So this is an interesting one. So Sanjeevji, what's your take on that?
So yes, you don't have to be a real estate professional. Don't have to be a licensed real estate professional. You don't have to be licensed. The main thing is that you're putting more than 750 hours or more than 50% of your time in the real estate than any other way. So if you can prove it either one person or 2%, and you have multiple properties, only having one property will not suffice, because why you're putting so much time on one property? You don't want to manipulate. So having multiple properties and doing the election on your tax returns as a real estate professional, of course, it makes sense.
Yeah. The only thing I will add to that is because both of you guys are a W-2, so it is certainly a red flag. So just be aware of that. That means your documentation needs to be really, really good. So, if you're okay with that, then go that route. I have done consultation before. Will there be any pricing discount for tax filing? So tax filing pricing is based on how complex the tax return is and how much time it's going to take that. So you can just reach out to the office and office can answer that for you. Okay. Deepak ji, are you able to see my questions on how much can I gift to my kids? I already answered that earlier, right? 18K is generally per person is the threshold. If a flat is sold in India by March 31st of the year, does it needs to be filed in the US tax return for 2024 or 2025? Like Sanjeev ji said, the standard protocol is that, obviously whatever transaction happens in India, you're going to file the Indian tax return. And once you have filed that return, based on that, your US tax return will be made. And if we need to file an extension, we file an extension. And we can certainly do it in advance. Like Sanjeev ji said, the problem is the risk of getting audited, which you would like to avoid if possible. So this is from Maya. I'm a U.S. citizen OCI card. So I already answered that one. Legal expenses on real estate, we answered that one as well. Some folks may prefer anonymous from privacy will be beneficial to honor the problem is not like I said, the issue is the fact that I don't know if that question is coming from one person or multiple persons. So let's say you put 20 questions as anonymous. Should I take your 20 questions or should I answer 20 questions for other 20 people? That's what the problem is. It's not no other reason. Like we don't want to convert it into a consultation call. Okay. Do I need to pay taxes in US if I gifted a commercial rental property located in India to my father residing in India in 2024? And could it be claimed as part of US gift tax exemption? I'm a US citizen. The same property was earlier gifted by my father in India when I was minor, residing in India more than 30 years ago. I have relocated to US permanently more than 25. So look, Ajay I think there are some complexity here. I would strongly recommend that you do a consultation to make sure we don't miss out. This could be seen as, transactions that might trigger taxes one way or the other, both from an India point of view and US point of view. Anytime you're doing these kind of transactions, good idea to do a consultation. Screen change from full screen to partial bottom is cut out. I'm not sure. I'm able to see full on my screen as well as on YouTube. So maybe something change on resolution for your computer. So sorry, can't help you with that. Can you please share some tax guidance and best practices for individuals investing in startup as angel investors and limited partners via a VC fund? Look, obviously the biggest thing is how do you do your due diligence in these cases? That's the big problem. So that's a big question here. My personal recommendation is that if you're investing in a startup, most likely you're investing in a startup because you think 1000x probability of growth. And if that's the case, maybe you want to consider self-directed IRAs to do transactions like those. So you might have heard of Peter Thiel built a big wealth around there. So that's the way I would do it. Sanjeevji, any pointer on that? I know there's a lot of people like to do that these days.
Yes, self-directed is, of course, it needs to be done with a lot of caution, because there is UBITA and other things related to that area. So yes, it's a way to go, but like I said, with caution and proper advice.
So this is an interesting one. This might be beneficial to a lot of people. If you have a medical issue for dependent and had to travel internationally for it, can that be reported for tax purposes? So we know medical expenses are in most cases, we cannot really deduct them because they have to be what I think 7.5% limitation, Sanjeevji, right now.
Yes,
Right. 7.5, like they have to be more than 7.5% of your AGI. So for most cases, the answer is no. However, it's not a strict no. There are ways where we can write off medical expenses, but we need more information. What do you do? When did the expense happen? So there is a way, but if it already had happened last year and you're asking this question, it might be too late. Sanjeevji, anything you want to add to that?
Yeah, agreed. I will second that one. It's all good. Yeah.
Okay. Can HSA fund can be used for parent medical or can only be used for wife and kids? So HSA funds are for your family. So in your family, it's just you, your wife, and your kids. At least that's the way they treat it in the USA. So those funds should be really used for those. I mean, technically speaking, HSA, you're asking for reimbursement. So I'll leave it at that. I hope you can understand what I mean. But technically speaking, it should only be used by the beneficiary, which is you, your wife, and your kids. Sanjeevji, any pointer there?
No, it's the
Uh,
same thing. Yes. Yeah.
all right. Can you please confirm if you can open one and invest in Coverdell ESA? Can you open and invest in Coverdell ESA for child for tax year 2024 till tax deadline of this year? So is he wants to set up a
$2,000. Yes. Yes.
yeah.
Coverdell. You can put that after tax money, but unfortunately, that is only allowed till December 31st.
Yeah. So you can do it for this year,
Right.
so for 2025, you just can't do it for last year. We have no income in India property and not showing in US tax return. If there's no income, then there's no need to show anything anyway. Uh, do we need to report when we sell it? And if yes, then how dollar rate helps to reduce tax? Again, that's a property question, guys. Anytime you're doing a property transaction, please understand that the reason why I always recommend do consultations, there are just so many variables. Anything with property, you don't want to do it with a generic answer. But no, if there's no income, you don't need to report in the US. When you do sell it, we're going to go back and we're going to take a look at, the dollar. And then a lot has to do with how it is reported in India as well. So you really do need a good CA to keep track of that. Any recommendation there, Sanjeevji?
Yeah. I will second that one. Go ahead.
Okay. And then, like I said, a lot of this will be also covered in the FBAR webinar as well, by the way, in great detail. So you're welcome to join that one. Okay. Do I have to report 120K foreign inward cash transfer from my foreign savings account to my account in the US? If yes, what documentation is needed? I had reported my foreign account through FinCEN form. No, if there is no income, then there's no income tax reporting there. So if you're just transferring your own money from India to US, then you don't need to report it on income tax. How is money repatriated from India taxes? I don't know. I think what you're talking about is like the taxes you paid in India. Is that what the question is here? What do you think, Sanjeevji?
So before we go there, the 120K that is inward transfer from the account, we have to again always whenever we talk about transfers from India, we always have to look at two things. One, the source of that money in that account, and second, the reporting of that account. So it's just not transferring money does anything, but you have to you have to see where this money coming from, and is it reported or not? So that's important to know. And for repatriating money from India, there's no tax on that repatriation. But like I said, source and validation of the account is important.
All right. So, okay. How does backdoor Roth IRA works and how does one go about it? And so we talked about that earlier, so I'm going to skip that question. Is a US citizen who has OCI considered an NRI? So, once you're out of India, at least for the US, Sanjay, how would you answer that? Because
So
how
when
does
it comes to non-resident, we are looking at non-resident from India tax point of view.
exactly?
There are two regulations. One is FAMA requirement, and other is Income Tax Act of 1961. So non-resident is governed by those two regulations. When you talk about FAMA requirements, if you're outside India for more than 6 months, you're considered non-resident. From Income Tax Act, you consider non-resident provided you fulfill certain requirements. You're a resident, you're not resident, or you're not in a resident but not on a resident status. So, and there are certain tests we have to fulfill. But generally, if you're outside India for more than 6 months, you are considered non-resident. The OCI has no meaning, absolutely, with respect to non-resident Indian.
Yeah,
Definition.
And we're going to talk about this subject matter in great details on the FBAR webinar, because so many times people become a US resident and they are still operating business in India as usual. And that creates all kind of problems. We are seeing people getting notices from 10 years ago, 15 years ago, because they are buying property, they have bank accounts. It's starting to be like India is starting, as far as taxes is concerned, India is becoming even more complex than US. So please be very careful with that stuff. Okay. My main
And
question.
Deepak, as a
Yes.
general, the information that we are going to bring in the next webinar will be eye opener for a lot of people, because we are covering very specific issues relating to when they go back to India, what things needs to be done, uh, and also or when they are in India having US source income, what needs to be done, or when they are here and having US source income, India source income, what needs to be done. So we are going to tackle different ways, and people are giving up green cards too. So we will tackle. It's going to be a lot of information, but very specific information because we get this a lot, and we are going to cover that in our webinar.
All right. So let's see. We are already past our time, but there are a few more
Yes.
questions, Sanjeevji. So I'm going to try to go as fast as I can. I moved from Maryland in July 2025. I'm retired and getting pension from Maryland State. Also, I'm working in California since August. How should I file? Do I need to file California and Maryland? So most likely, yes. But I would, if you have multiple states involved, like Sanjeevji said earlier, I would recommend don't do it yourself. Involve a tax professional to help you with that. Um, I'm Jake and Sanjeevji manage my 401k, please. No, we don't really manage 401ks, but we can certainly advise you on from a tax point of view. Energy efficient new doors and windows, how much credit one gets for living in primary residence home. I don't know the credit on top of my mind. Do you,
No,
do you know?
it's a different categories. Overall, is 1,500, but there are different category for doors, different category windows, like 500. 500 is subcategories of that one. Overall category does not exceed 1,500.
Yeah. So my recommendation would be is, wherever you buy them from, they usually tell you that what they will qualify for. That might be a good starting point. 1099-A tuition, how much is the deduction applied on 1040?
Depends on the qualifying standards, what is using that money for, right? And how is it being paid? Yes. And what is this used for, AOTC or lifetime learning credit?
Yeah. I'm retired and disabled over 58. So can I give 50K per year out of 401k? My empowers keeps me 20. I'm assuming you're saying employer maybe keeps
No, it's a
20%.
confusing question.
Yeah.
Confusing, it's not clear.
Okay. So I'll leave that alone. Can I claim foreign tax credit on foreign taxes paid from Vanguard Total International Stock Index dividends, even if I
Mhm.
don't sell the shares?
No, which we get a lot, this type question. No, it's no, you can't claim the foreign tax credit because you're not filing that income on the foreign return and paying tax on that foreign return. Foreign tax credit is for taxes paid in a foreign country, not just because you're holding a stock invested in foreign country.
Um, yeah, it's like if that was the case, then I mean, Google owns a lot of businesses in India, right? I should be able to claim that. So it doesn't make any sense there. Okay, I have 1 million in 401k, so 18K to all kids per year. Uh, I think once again, it's a gift question. Keep coming up again and again. Yes, 18K per person you can gift. Your wife can gift 18K. And then you can also gift 18K to your grandkids. So it's per person per year limit. If someone has a dependent parent in India and they support their parents for their yearly expenses, what do they need to do to claim them as dependent when one file taxes in US?
Well, if you have dependent parent, is a dependent parent, does not create any dependency for US tax purposes, unfortunately.
Yeah, basically you're gifting them support, right? That's what you're really
Yeah,
doing. So
because
that's what.
they have to fulfill the dependency definition, being a resident of this country. If they are not resident of this country, unfortunately, you can't claim a non-resident dependent on your
Yeah.
US tax returns.
And trust me, if you could, let's just say if you could, do you know how many people will claim dependents in India? I think Indian tax return will be filled with like 300, 400 dependents. So you know how people use that stuff. Okay. Um, All right. What is the tax benefit to give vested RSUs at gift to kids, and how much we can give every year? So once again, any gift, the limitation is that 18K value. So if you have large amount of RSUs, like it's like maybe you work in Nvidia or some of the high flying stocks out there, and the idea here is how to save on those capital gain taxes, then please reach out to Sanjeev and set up a consultation and talk to him about that. But let's talk about, in generally speaking, Sanjeev ji, gifting vested RSU to kids. What's your take on that?
Well, I will not gift RSUs to kids because NVIDIA is a very, very high risk stock, according to me. So, what happens if you have to sell it and you lose your patience? So, again, it depends on the age of the kid. You might end up paying taxes on your return. So, why should we take that? So, if you are gifting something, gift something which is stable, like treasury bonds, uh, tax deferred, tax deferred strategies, rather than giving technology stocks, which are very speculative in nature. And I will not give that. I will give more stable stocks, more stable like bonds and other things to the kids.
Okay, this was an interesting one. I had a LLC in Kentucky and I'm based in Washington. This closed recently as we didn't do any actual business. What taxes do I need to file? So if you didn't really do any business, there is no taxes, but both states, you might have to file the tax return. And if you're going to close that out altogether, then we need to file it at the final return and be over with it. And then also depends where do you live now. So there will be we have to deal with that as well. But there's no taxes due per se because there's no income. Paid advance tax using wife's social security number while always file taxes as jointly with husband's social security number as primary. Hope still can file husband as primary or no need. I don't think it makes any difference. Does it, Sanjeev ji? If you, yeah,
No.
because you're married filing jointly anyway,
Yes.
so it will all. Okay, Gopalji said Greenland as well. Yeah, absolutely. And who knows, man? Trump keeps changing his mind, so he's thinking expanding. Modi ji is coming, by the way. Who knows? He might ask for something from Modi ji as well. Be like, hey, why you guys always fighting over Kashmir? Let US take over. We will manage it for you. If I give
And
10,
let Kashmir go somewhere else.
no, like we will manage it. We'll create a tourism industry over there. We'll manage it. If I give 10K to my parents, is that amount tax deductible? Funny, Ravi bhai, you're gifting and then you're asking for deduction. You don't get gift for deductions. You don't get deduction for gifts. You need to donate to a qualified charity to get a deduction. And even in that case, you have to itemize. So a tricky one. But like I said, whenever whenever we're talking about gifting and stuff, what you're really doing is income transfer. So there might be an opportunities around that, but those we need to do this, consultation and kind of figure out if there is an opportunity around that. So JDU is a joint dwelling unit. Sanjeev ji, we are getting a correction here. ADU is an additional dwelling unit. JDU is a wall shared with the original house. How tax filing different? Makes no difference. Doesn't matter. If it's it could be part of your house. It could be 10 feet from your house. It could be another house. If you're using it for investment purposes, then we treat it like an investment property. If you're using it for primary purposes, it could be even a room in your existing house. Makes no difference at all. Sanjeev ji, anything you want to add to that?
Yes, we can talk about ADU a lot, but time is the constant. So yes, I will take it for whatever you shall decide.
Yeah. Sudhakar is asking for a joke from Sanjeev. I'll ask for that once I get a couple more questions. Okay, so this is I heard that you can do cost segregation on a long-term rental and get it deducted against W2. No, that's not correct. A long-term rental deduction against W2 does not work. So that is wrong. So it's only short-term rental, or you have to be a real estate professional, or at least your wife has to be a real estate professional. That's the only way it would work. So that's out. My employer allows to mega backdoor Roth IRA, which limits the 69K, including everything. Can I contribute to this mega backdoor fully after tax instead of contributing to 401K pre-tax? Or is there any rule like first I have to complete my pre-tax and then to post-tax mega? So I think if you're like Sanjeev answered that earlier, right? If you're company allows you to do that, if they set up the structure that, hey, instead of putting pre-tax, just put post-tax. Sanjeev is saying if your plan allows that, that's completely okay, as long as the total contribution limits do not exceed for employer contribution and employee contribution. Sanjeev, am I correct?
Yes, yes, yes.
Okay. All right. Been in US for a couple of years and claiming all Indian returns in US without missing. Do we still have to file the Indian taxes in India if you're not filing from years? If we start file from now, is it poking income tax department run behind? If you have an income in India and you are required to file taxes, then you should file the taxes. I don't know how to really put it any other way. But if you're
It's
not,
not, it's the people are worried that if they start, what will happen to prior years? Anyway, you have to start somewhere. What happens if, like I said, with the Indian budget that are coming up, they're tightening the regulations for non-resident Indians. What will happen then? What will happen if you land at the Indian airport and the custom officer don't let you go inside? So things are changing, man.
yeah, I mean, the lot can happen. I mean, they can put it on. Who knows? They can go as extreme as put on do not fly list or something else. I mean, it depends how how crazy they want to go. Do you do 3520 filings? Sanjeev
Yes,
ji,
yes,
that's for
definitely
you do.
part of the return. Yes,
Okay.
part of the returns.
My wife has a traditional rollover IRA. If I convert from IRA to Roth, I don't have any traditional IRA. Do I need to consider my wife IRA? So IRAs are for each individual. So if you're doing conversion, you're doing conversion for yourself, and you're doing conversion for there's no like married married Roth IRA. Sanjeev ji, anything I'm missing there?
Yeah, yeah, you're right.
Right. Okay. Yeah, I just like to verify everything with Sanjeev ji, because it's his webinar, so I don't want to get in trouble. Just for clarification, if you're wondering why I keep asking. If we get taxes done from you, will you suggest ways for reducing taxes? All right, Ashokji, this is a wonderful question, and thank you for asking. So 2 pointers here. Number one, if you coming for tax filing, then people are focused on tax filing. If you're looking for strategies, then you really need to do consultation. So just call the office, say, hey, I want to set aside 30 minutes with Sanjeev. I want to talk to him about my tax situation. And that's the 30 minutes that you talk about strategies. You don't talk about strategies while you're filing your taxes. And that applies for everyone because think about it. People are, tax professionals are super busy. We don't have entire year to do taxes. We got to do everything by April 15th. So people don't have time to really spend their time that they could spend on wrapping up somebody other taxes, which if they don't, they can run into penalties and all other kind of problems. So please, if you need some help, set up an appointment with Sanjeev ji and take care of that. Okay, I'm invested as an angel investor 2 years ago and have not received any returns from it. Will be any tax benefit for this investment? Investments are interesting because there is no direct tax benefit if you don't make any return on it. It's just a loss of investment. However, that is not entirely correct. It just depends on how investment was made to begin with. But in most cases, there is no benefit. Sanjeev ji?
Yes, there's no benefit. And Deepak, we have to keep a watch on our timings. It's already 12:30.
Yeah. So I think we only have
Let's
couple more
yeah,
questions.
let's wipe out the let's come to the
Okay.
few questions
Uh,
at the
I
end.
I took
Otherwise,
I
I can carry this to for another hour. So we are short on time.
Yeah. I took INR 50 lakh from home construction loan in India in 2024. Do I have to report this information during this tax return? Look, if the money hit your account, you probably have to respond to FBAR because 50 lakh is obviously certainly over 10K. I invested in startup in 2019, didn't receive. Okay, this is the same question. I have a rental property in India. Should I report it here in US? You don't need to report a rental property, but if you're making an income, then you certainly need to report that. And if you have a bank account and whatnot, you need to report that. Is money invested in treasury bills taxable in California? I think Sanjeev ji already answered that. They're not taxable in California. Correct, Sanjeev ji? I think you talked about
Yes,
it earlier.
yes, 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 yes.
Okay. Is it possible to gift 401k Roth to my kids? You don't gift from your 401k, guys. You're going to take a distribution from 401k. Your kids can inherit your 401k, but you don't gift out of 401k. Follow-up question: paying all Indian profits in US tax filing return, do I have to report even to India income tax department? So again, that's the same one. Sanjeev ji answered that already. Do you do for all states? Yeah, we certainly do it for all states. Please tell us what happens in consultation. Client may have 20 topics. So we limit it based on timing. So Sanjeev consultations are 30 minutes. So whatever you can ask in 30 minutes, you can do that. But you're not limited by 30. You can always book 2 consultation, 4 consultation, 5 consult. It's up to you how long do you take. But trust me, Sanjeev ji is very good in giving a lot of information in short period of time. As you can, you already experienced that in webinar. I'm still learning that skill from him. But I'm still a work in
See the
progress.
yeah. See the thing is, Deepak and all the people who are here, participants, it's not about 20 topics. It's how much you can grasp within that half an hour. Okay, you can have hundred of topics. Will you be able to grasp? Then what happens if I tell you within that half an hour so many things? Most of the time, people say it goes over my head. Can you hand hold my hand? Can you do this thing for me? Can you do this? It's too much. So it's not about topics. It's about what you're looking for, right? What's your main pain points are. That's the main thing should be, not covering every topic in that consultation.
All right, guys. So I think I did my best to cover as many questions as possible. I think we must have covered over 100 questions in today's webinar, and you can imagine that's like 100 consultations for Sanjeev. So thank you so much, Sanjeev ji, for spending your time and making sure you answer everybody's question. I will encourage everyone to, uh, reach out to sanjeevcpa.com and at the bare minimum, talk to us about our tax filing services. At the bare minimum, whether you do business or not, that's a different story. But I think by by becoming our client, you'll get so much value. And I want to spend 5 minutes on that, Sanjeev, if you don't mind. Uh, Number one, you're going to get a great tax return. People who work for us are extremely professional. Um, Number two, you're going to get a lot of good information, a lot of good information. Sanjeev ji run these webinars few times a year, and you can see they're very in-depth, very detailed oriented, and we take our time to answer all of your questions. It's all free. There's no charge for that. I personally do a lot of webinars. I talk about market updates. I talk about real estate updates. You get access to all of those for free as well. Then once a year, we do Wealth Summit, and that's going to happen again in November this year. Last year, we had 600 plus people join that Wealth Summit. It was an awesome event, so you get access to that as well. I don't think anybody else does it anywhere else in the country, so that's a very unique event to us. So trust me, you get a lot of value for doing business with us. And if you want us to pay attention to your finances, to your returns, time is now. Don't wait till March. You know, reach out to us right now. Let us help you. Sanjeev ji, anything you want to add to that?
So the thing is, why we are different from other CPA, the tax professionals. You rightly pointed out, we do these webinars, we spend time in research, we go to education, we train our staff, we train our people, we train everybody who is connected with us. We give so many pointers to clients. It's shocking to see returns filed by the CPAs, by the tax professionals. Really, when I see those returns, uh, I just can't believe it. It's just the way the returns are being done with no planning, nothing going. People are looking for information. They don't know. They talk to their friends, their neighbors, everywhere. They get the wrong information and they do the things the way they want. So it's again there's 6,000 pages of tax code. Around 6,000 pages of tax code, 80% of that tax code says to save taxes. Only 20% says to increase taxes. But we have to do things the way they want us to do. The IRS does not want to take excessive tax from us. They say what is ordinary and reasonable, give us those tax. But people don't know. People don't know what they don't know. So it's important. You have to give value for the consultation. You have to give value for the time, and that creates value for yourself on a return. So that's what I will say. So don't creep about doing online or don't saving money. I said for tax provision fee of $300, $400. That's not what you're looking for. What happens if you can save $4,000, $40,000 in taxes? That's what you should look for. Don't go for smaller cents. Go for a dollar saving rather than a cents in a dollar.
So Sanjeev ji, do you want to leave us today um,
Joke?
with a joke? Yeah.
Yes. So one son came to his father and said, one son came to his father to show the grades of the school. So the father looked at the report and said, "Oh, wow, these grades, what does this grade look like? It's like that why these grades are so low. So the son says, "Sir, father, this grade is after taxes."
I wonder if the father was a tax professional. All right, Sanjeev ji. Always deductions there. All right, guys, thank you so much. And I think 2025 is going to be a great year. There is a lot of stuff going on. President Trump is gonna, come up with some interesting tax policies. We'll get to know more about those in the coming weeks. I'm planning on canceling my Netflix subscription this year because I can get all the entertainment from news these days. So what's the
So first thing if I see in the morning is a news on it. I'm so hooked up. Not only Netflix, we should cancel all kinds of smart TV we have, right? It's Prime Video and everything. It's so interesting to see him talk, right? And say things.
You can get your jokes from him. You can get your finance information from him. You can learn everything from him these days. So
And even the vice president that sits along with him on the dais, like on the stairs, on the downstairs, he just asked the question, "Hey, vice, did you tell him? Did you tell like this? Did you say I'm with you?"
uh, but
That's a joke, man.
yeah, so please enjoy the time. I think me and Sanjeev will agree that I think business owners, this is a great opportunity in 2025. If you guys are not thinking about setting up a side hustle, if you guys are not thinking about maybe buying an established business, if you're not thinking about doing something that you have not done before, you're going to be lose out on a lot of opportunities. Real estate, commercial real estate, short-term rentals, businesses, those are the things you need to look into 2025. I think, and I did a video, last year, and people were really skeptical about 2025 because we had great markets for last 2 years, and I argued why 2025 will be just as good of a year, and I had my own thesis behind that. So I think all of those pointers are starting to come true. So please look into don't shy away from things that you can do that can help you reduce taxes and help you build good wealth in 2025. There's a lot of opportunities. All right, guys, thank you so much for spending your time with us. And Sanjeev ji, I'll talk to you very, very soon. And this was an awesome webinar. I certainly learned a lot. Hopefully, everybody else got to learn something new today.